Baroness Udin.
I thank the House for its leniency and welcome the super register which is being proposed. I wish to convey my thanks and respect to all the noble lords who have spoken in this debate, and it's been such a deep, long-standing hope and honour to have participated in a small way in this debate, and I wish to extend my thanks to Noble Lady Baroness Williams, Noble Lord Wolfson and Noble Lord Parkinson for their contribution and dedication to this cause. And it has been very noted, the sisterhood across the House was very incredibly powerful, so I wanted to state that. We do have a common purpose in making real changes to the lives of survivors. May I ask if there will be a public information campaign to empower women with a message that our society has marked this day to change the way we utterly reject violence against women. It is everyone's business, as has been said, to begin the process of eliminating violence and abuse. It will send a very powerful message to all around the world that we do intend to stand against violence and abuse in every form.
Minister?
My Lords, I'm grateful for the comments from the Noble Baroness. Of course, this government opposes violence in all forms, in particular violence against women. As to the publicity campaign she mentions, she will be aware there are a number of areas in which the government already has publicity in this area. I'm very happy to speak to her to understand particularly what she has in mind, and I will arrange to have that conversation in due course.
The question is that this bill do now pass. As many as are of that opinion will say content. The contrary, not content. The contents have it. My Lords, I believe it is the intention of the House to proceed straight away to next business, but we should have a short pause perhaps for rearrangement of front benches and so on. My Lords, we now come to the report of the Financial Services Bill. I will call members to speak in the order listed. Short questions of elucidation after the Minister's response are discouraged. Any member wishing to ask such a question must email the clerk. The groups are binding. A participant who might wish to press an amendment other than the lead amendment in a group to a division must give notice in debate or by emailing the clerk. Leave should be given to withdraw amendments. When putting the question, I will collect voices in the chamber only. If a member taking part remotely wants their voice accounted for if the question is put, they must make this clear when speaking on the group. We will now begin. Report of the Financial Services Bill. Minister.
My Lords, I beg to move that this report be now received.
The question is that this report be now received. As many as of that opinion will say content. Contrary, not content. The contents have it. Before Clause 1, Amendment 1, Lord Stevenson of Balmacara.
My Lords, I'm moving Amendment 1 in my name and that of my noble friend Lord Eatwell. I thank Lord Sharkey and Baron Splendid Man of Council for adding their cross-party support to this important issue and look forward to their contribution to the debate. I'd also like to thank the Noble Baroness Penn, the Deputy Leader of the House, the Noble Earl Howe, and the Noble Lord True, and their officials for making time to discuss this issue after committee, which has helped us considerably, and also shed some light on the complex set of consultations which the FCA and the Treasury itself are conducting over the next few months, all of which, of course, are happening during the pandemic and at a time of significant change in duties and responsibilities on all quarters. My Lords, in his excellent speech at committee, my noble friend Lord Eatwell set out the case for the introduction of a duty of consumer care to be placed on financial service providers, which he argued would strengthen the FCA's consumer protection objective and introduce requirements which would ensure that firms operating on the financial sector should not profit from exploiting a consumer's vulnerability, behavioural biases or constrained choices. And I can do little better than to rehearse his main points again. Markets in financial products sold to individuals, households and small businesses are seriously inefficient, mainly because of asymmetric information, as the seller of the product typically knows much more about the risks involved in making a particular investment or other financial transaction than does the consumer. Secondly, given that the FCA's strategic objective is about promoting competition in the market, thereby improving consumer outcomes, it can either regulate each individual financial product to ensure that the consumer is properly informed, or it could adopt the principle enshrined in Amendment 1 and make general rules, including the power to introduce a duty of care owed by the authorised persons to their consumers. The case for a duty of care for consumers was argued very strongly at the time this current regulatory structure was set up. Indeed, I was present in many of those debates. But absent primary legislation or changes to it, the FCA has perforce adopted the first option and attempted to deal with each consumer detriment issue as it arises. But by its own admission, this has not gone very well. From its consultation entitled Our Future Approach to Consumers in 2017 through to the feedback statement published in April 2019, the FCA has wrestled with the issue of duty of care and indeed is still wrestling today, with a review scheduled to start, we understand, in May 2021. Now, my noble friend's case was that the status quo is failing and that a new approach is urgently required for two main reasons. First, because new products are always coming onto the market, which means that the FCA is always playing catch-up to introduce new rules and, of course, has to take time for appropriate consultation and so on to deal with the new threats to the consumer. And the rush to get a handle on the buy now, pay later products in this legislation speaks volumes about that approach. And secondly, the fact that financial products are now available with one click via the internet, with all that implies about the failure of the conventional approaches of know your customer and the need for careful concern about going through the paperwork and understanding the terms and conditions of what you may be signing up to. In short, fintech, for all the benefits it can bring, well argued by the Noble Lord Holmes, signals the end of the current FCA regulation as we know it. Going forward, the case for a duty of care approach is unanswerable. Amendment 1 provides the FCA with the means to end its failure to meet its consumer protection through dogged adherence to a failing competition objective. The enactment of the power to introduce a duty of care for consumers would rightly place responsibility for ensuring that markets function well firmly on the shoulders of those who have the information required to attain that goal. If the FCA has the power to introduce a duty of care for consumers, it could finally begin to live up to its strategic objective. Far too many consumers, my lords, are being treated inappropriately, whether by the mis-selling of products, the denial of rights, or by obstructionist responses to complaints and so on. If the government wished to improve on the consumer protections previously enshrined in EU legislation, the introduction of a duty of care on consumers is a safe and sure way forward, a way to ensure that markets function well for the benefit of the consumer, as it should be. Now, my lords, I'm sure that when she comes to respond to this debate, the noble Baroness Lady Penn will try to persuade us that there is no need for this amendment, as the future consultations to be carried out by the FCA and by the Treasury will cover all these points in detail, and so all will be well. Indeed, it may be that either or both of these exercises may require primary legislation, and that is, it's quite likely we will be back again in a few months' time debating the same issues all over again, when the Treasury has decided on its response to the consultations and brings forward legislation to implement another generation of regulatory frameworks. But I put it to the government that while the wording of this amendment may not be perfect, the intent, and particularly the wording of Section 2, that firms should not be profiting from exploiting a consumer's vulnerability, behavioural biases, or constrained choices, is worth holding on to and taking action now. So, my Lords, I give notice that absent a positive response today, I am minded to test the opinion of the House on this amendment. However, if the Noble Baroness Minister would be prepared to commit to bring this issue back at third reading with an agreed wording, then we could work with her to settle this issue. My Lords, I beg to move.
Amendment proposed: before Clause 1, insert the new clause as printed on the marshalled list. I call the next speaker Lord Sharkey.
It's a pleasure to follow the Noble Lord Stevenson of Balmacara, and to support this amendment. The Noble Lord has made a strong and compelling case for both parts of the amendment. The case for and against the duty of care was discussed extensively at Grand Committee, and I don't propose to revisit the arguments in detail. In his speech at Grand Committee, the Noble Lord, Lord Davis of Brixton, made a very simple but important point when he said that the truth is that the industry has a systemic tendency to malfeasance. I listed in committee some of the very many serious instances of malfeasance over the last couple of decades. And I'm sure they're very familiar to all of us, and they amply demonstrate the truth of Lord Davis's observation. And there can be no doubt that the temptation to malfeasance and the opportunities for malfeasance grow and are deeply rooted in the huge inequality of arms. Lord Eatwell emphasised this in committee, as Lord Stevenson has just noted. And there can be no doubt either that the culture within parts of our financial services industry is, to say the very least, not orientated to serving the best interests of consumers. John Lanchester has graphically described the industry as treating its customers as an extractive resource. All this is true in an industry which is highly regulated, which inevitably leads to the conclusion that the regulatory regime is obviously and severely deficient. The FCA has consulted on the duty of care at least 8 times in the last 5 years, and is about to do so again starting in May, apparently. It's not clear, given the Treasury's current consultation on the FSFRF, why we need 2 consultations covering the same ground. And I know that some respondents to the HMT consultation have already proposed a new duty of best interests or duty of care. And there's no reason to suppose either that this new and much delayed FCA consultation will come up with anything more than equivocation, fence sitting, or long grass if its previous efforts are anything to go by. Last time round, the FCA found that most respondents considered levels of consumer harm to be high and that change was needed to protect consumers. None of the financial services respondents wanted a duty of care, but 92% of consumers did, in a popular survey commissioned by the FCA's own consumer panel. The industry resists a duty of care for obvious reasons of self-interest, sometimes presented as a concern that such a duty would increase costs ultimately to the consumer. This doesn't say much for our financial services belief in competition, nor does it acknowledge the fact that, for example, PPI was sold at a commission rate of 87%, nor that the industry has had to find the funds to pay over 50 billion in redress for PPI alone. The government has argued that a duty of care is not necessary because, to quote Baroness Penn, the government believes that the FCA already has the necessary powers to ensure that sufficient protections are in place for consumers, and it has the will to act without the need for a statutory duty of care. Not even the FCA agrees with the first bit of that. In evidence to our liaison committee last Tuesday, Sheldon Mills of the FCA was reported as agreeing that the concept of treating customers fairly needed more development if it was to protect them. He confirmed that the FCA would be consulting on options to deliver a higher level consumer protection in markets. It would really be very hard to look at the disasters, catastrophes, rip-offs and assorted scams that litter our financial services landscape and justifies those 2 ministerial assertions. Where is the evidence of sufficient protection? Where is the evidence of will to act in any timely fashion? If the government really believes in sufficient protection and will to act, how does it explain the FOS data? In 2019-20, the FOS dealt with 250,000 cases. 1/3 of these were judged in the consumer's favour, evidence of ongoing, large-scale malfeasance. The figures are even worse when it comes to products aimed at the financially vulnerable. 89% for guarantor loans, 84% for doorstep loans, and 78% for logbook loans. This doesn't show sufficient protection or will to act. It shows failure to sell the right products to the right people, or to explain it properly, or to handle complaints properly. Customers are surely right when they told the FCA Consumer Panel that the customer is not at the heart of business decisions. My Lords, FSMA 2000 does not protect consumers adequately. The FCA is always playing catch-up. Malfeasance continues to grow and to take new forms. Redress is patchy, time-consuming, and very stressful. The duty of care would address these problems, and that is what the FCA Consumer Panel recommended in its submission to the Treasury's FSFRF review last month. A duty of care would provide a strong and clear incentive for real and lasting cultural change in our financial services industry. I hope the Minister will be able to accept our amendment or commit to bringing an equivalent to us at third reading. And if not, I hope the Noble Lord, Lord Stevenson, will press this amendment to a vote.
I call the next speaker, Baroness Altman.
My Lords, I am very pleased to speak to these amendments, and I have worked in this industry for so many years, and the number of scams, frauds, and scandals that have plagued consumers is ongoing. It seems clear, as the Noble Lord, Lord Sharkey, has just said, that the Financial Services and Markets Act in 2000 does not protect consumers. And I thank the Noble Lord, Lord Stevenson, for his clear explanation of why this particular amendment, in all its parts, is required. My Lords, a duty of care on providers to make sure that they are considering the interests of their customers would certainly help address the asymmetry of information between the providers and the consumers, and might also assist customers in the manner of the products that are developed and offered, because too often providers are developing new products with new complexities which are clearly not user-friendly. And then the FCA requirements are that the risks and details of the products must be disclosed. Well, these disclosure documents are impenetrable to the ordinary person. Those working at the FCA and those working for the providers understand the language used. It is natural to them. But for the vast majority of the public, they really do not understand what these specific product literature, which the FCA has currently been relying upon to offer this kind of protection, what it actually means. And it's clearly not helping consumers to be faced with bamboozling jargon and many pages of legalese in the product descriptions and the terms and conditions. The FCA has consulted on this in 2017, it's released a statement in 2019, and other consultations have covered this as well. But I would urge my noble friend on the front bench, and I do congratulate the government for having engaged in this issue, and my noble friend Lord True, and my noble friend Baroness Penn, and my noble friend the HoL. I know they have all worked on this issue, but from a practical perspective, as someone who has worked in this industry, developed product for consumers, and also worked with consumers on the other side who have suffered detriment, I believe that the fears about competition are somewhat overdone. All firms, if they have a duty of care, will then have to look after customers. So the issue of competition should not really pose so much of an impediment. Markets currently function in the interest of providers rather than consumers, and regulators are reactive to problems rather than trying to preempt problems that have been highlighted and pointed out for 2 or 3 years before anything is actually done, by which time so many consumers have lost out. Of course, I believe that firms should not profit from exploiting the lack of understanding, and also, my lords, the lack of education of the public when it comes to retail financial services. And successive governments have talked about improving financial literacy, but they have not managed to achieve this. And my lords, in practice, providers do not know their customers. The customers do not understand the product literature. And indeed, there's no requirement, it seems, very often for the provider to even ask basic questions of the consumer before the consumer buys a particular product. There are countless examples of areas where just a basic question could have prevented a consumer from buying an inappropriate product. So, my lords, I urge my noble friend on the front bench to take up the offer of the noble Lord Stevenson and work with him and other interested peers to come up with a form of words for third reading that can prevent a vote on this issue, and which can also help accelerate the important duty of care that is required. Waiting for a consultation later this year, my lords, is simply not good enough when it comes to the kind of scandals and scams that we know are going on day in and day out. Thank you, my lords.
I call the next speaker Baroness Bennett of Manor Castle.
My lords, it's a great pleasure to follow the noble Lady Baroness Altman and her powerful plea that I hope the government will listen to. I speak also to Amendment 1 in the names of the noble Lord Stevenson of Balmacara, Sharkey and Equal, to which I was pleased to attach my name, as I did to a very similar amendment at committee stage. And any noble lords who've been reading back to second reading will note that I majored on a duty of care in my speech in that debate. In that I used what you might call an expanded definition of duty of care, so to suggest that it might not be too much to put on the face of the bill a demand that the financial sector not engage in reckless, fraudulent, corrupt, obviously damaging systemic behaviour, including shipping off tranches of cash into tax havens, deploying complex financial instruments that they clearly don't understand, handing over control of markets to automated systems without adequate controls, things that threaten the security of all of us. But while I believe that principle remains sound, the lawyers convinced me that in narrow legal terms, duty of care could not be stretched that far. So what the amendment here clearly introduces is a duty of care to individual customers. As clause EA here says, that their vulnerability, behavioural biases or constrained choices should not be exploited. Once perhaps such a clause was not necessary. There was a not ideal, but certainly useful constraining paternalism. Your local bank manager would look after you, both in limiting borrowing and making allowances for unexpected disasters, personal and business. That's long gone, as of course has almost universally the local bank manager and all too often the local bank branch. So we need the law to step in to protect people, to constrain the behaviour of financial institutions. As the noble Lord Sharkey said, we're in situations where malfeasance has just continued to grow, technical developments being one cause of that. And as the noble Lady Baroness Altman said, scandals and fraud have plagued consumers. So that's the institutional side of where we are. But we also have to think about the state that people, our society is in today, make the law fit for our modern times. For these are times of massive insecurity. The idea of saving, of even making the incoming funds match the essential outgoings each month, was an impossible dream for millions of people, even before the arrival of the SARS-CoV-2 virus. No one can know when sudden illness might strike, and this bill has been championed, and I pay credit to their work, by Macmillan Cancer Support. Or it could be a redundancy or a pandemic that strikes people unexpectedly. That's one side of vulnerability and care that financial institutions should acknowledge. As Macmillan highlights, almost 1 in 3 of those severely financially impacted by their cancer diagnosis had to take out a loan or credit card debt. That's a public health issue. What we have are institutions that have been making profit from customers, sometimes for decades, and they have a duty to act compassionately and fairly in such circumstances. But I think we also need to pay a bit of attention to the elements of this clause referring to behavioural biases and constrained choices. The Noble Lord Holmes of Richmond has been a rather isolated champion in this bill on issues around the use of artificial intelligence, algorithms, and issues such as their potential bias. But the Noble Lord has also highlighted the way in which financial companies now have a historically uniquely detailed understanding of customer behaviour and the chance to exploit that through complex, opaque mechanisms. There has always been, as the Noble Lord Stevenson of Balmacara said in introducing an amendment, asymmetrical access to information between financial sector companies and their clients. But this has been massively magnified by technology, something that's only likely to grow. To create an assumption that this inequality of arms should not be misused should, we hope, constrain the behaviour of the financial sector. Or at least, if it doesn't do that, provide a potential route for redress should it occur. There are already many who have need to seek redress for the behaviour of financial sector companies. I spent time with some of them this morning at a meeting of the Transparency Task Force. As the Noble Lord Stevenson said, the government is likely now to say, wait, but why? We know there's already an existing massive problem and a huge risk. If the government does not acknowledge the need to act now, then I offer the Green Group's strong support for Lord Stevens' intention to test the views of the House. Thank you, my Lords.
Lord McNichol of West Kilbride has withdrawn from the debate, so I call the next the Baroness Tyler of Enfield.
My Lords, I am pleased to speak in support of Amendment 1. Firstly, I must apologise to the House that I have been unable to participate in earlier stages of the bill, a matter of real regret to me, but I have been following proceedings closely. I declare an interest as a member of the Financial Inclusion Commission and President of the Money Advice Trust. My Lords, I am very keen to support this amendment, which takes forward a very important recommendation from the report of the Financial Exclusion Select Committee, which I chaired in 2017. That report recommended both an expansion to the remit of the Financial Conduct Authority to include a statutory duty to promote financial inclusion, as well as a statutory duty of care. In my view, the two are closely linked, but we're obviously focused now on this very important duty of care amendment. My Lords, at the Liaison Committee's follow-up inquiry on financial exclusion held only last week, powerful evidence was received from charities and other active in the sector that the commercial model only goes so far and that legislation is required to put an obligation on banks and other financial service providers to provide appropriate services to customers and have proper regard to inclusion. My Lords, at present the regulatory principle that firms should treat customers fairly only, in my view, enshrines a weak duty to the consumer, further weakened by the principle in the Financial Services and Markets Act that consumers should take responsibility for their decisions. Treating customers fairly does not remove conflicts of interest and so does not provide sufficient deterrence to firms from mis-selling products and services, of which we've already heard examples this afternoon. Bluntly put, the consumer responsibility principle fails to take into account the imbalance in market power between firms and their customers. And I think a good example of this was the overdraft charges, where it was clear that they were disproportionately falling on more financially vulnerable customers. Banks could and should have known about this and done something about it, but they did not act by themselves and then and then regulation was introduced. So that's why I support a duty of care on firms to act in their customers' best interest. A similar duty already exists in other sectors. For example, for legal and medical professionals through the Solicitors Regulation Authority's principles or the General Medical Council's Good Medical Practice Guide. So there is very clear precedent here. I believe a duty of care on all financial service providers would ensure that they take a much needed proactive approach in their dealings with customers, acting in their best interests and reinforcing the principle that a firm cannot profit from consumers' vulnerability, biases or constrained choices, as we've already heard this afternoon. And in my view, and I think this is very important, it would also incentivise providers to ensure that products and services are what's called fair by design, with inclusion built in from the very start, which I think is very important. My Lords, in 2019, the Treasury Select Committee concluded that they would support a legal obligation, saying, and I quote, "While a legally enforceable duty might still require consumers to take their own legal action to seek redress against a provider, its very existence would remind providers of their duty to act in their customers' best interests at all times." My Lords, that is the very nub of the matter and the reason I strongly support this amendment.
I call Lord Holmes of Richmond.
My Lords, it's a pleasure to take part in this first group of amendments on the first day of report stage of the Financial Services Bill, and in doing so I declare my interest set out in the register. Can I congratulate Lord Stevenson for bringing this amendment and the way in which he introduced it. These are very much the arguments that have been put since at least 2017 when we ran through the Financial Claims and Guidance Bill. What's happened in the interim is merely to strengthen those arguments and the need for a duty of care. And indeed, what we've seen over the last year, as in so other many areas of life, is exactly why something in this space would assist. And indeed, as we come to the stage we are now with the excellent vaccine rollout and inoculation programme, such a duty could really put a capital B into the Build Back Better approach. This would really be an example of better. I won't re-rehearse the argument I made in second reading and at committee. I'll certainly take this opportunity again to thank Macmillan Cancer Support and congratulate them for everything they continue to do in this area. They call it the testimony of a cancer patient. It felt like I was fighting my bank as well as fighting cancer. Can I ask my noble friend the Minister if she will consider what can be done between report and third reading? It's more than timely, and with the Easter break between report and third reading, it's timely and there is time. So in conclusion, can my noble friend the Minister reassure noble lords that there is potential to move on this specific point on a duty of care?
Kramer. I'm going to be very brief. I spoke on this issue at length at committee, and I think the government may take note that every single speaker today, and there have been speakers from across the House, has supported the concept of a duty of care and non-exploitation and urged the government to act. As my lords, in all of the speeches, both before today and again referenced against today, we've heard this sort of chain of malfeasance, whether it's been described as scandal or fraud, or abuse of customers. Clearly, the existing legislation doesn't work, or we wouldn't have this kind of history and new scandals cropping up on a sadly regular basis. My lords, treating customers fairly, like it or not, is well interpreted by both the industry and the regulator as exceedingly light touch. and to be very much offset by the caveat emptor phrase that Lady Tyler referred to, taking personal responsibility. My Lords, this is unacceptable. The outcomes have been unacceptable, and I know this government often says it focuses on outcomes. So look at the outcomes, the chain of scandals, and I would say to the government, here is the opportunity to act. Now, the Minister might say in response, we've got, effective tools like the senior managers and certification regime. But again, anyone who has followed the process of this bill and amendments through committee stage will have heard how that has broken down. In effect, has become something of a busted flush. That the Minister might say, well, scandals be picked up very early because we have working whistleblowing channels. Again, listening to the whole discussion that we had throughout the committee stage makes it clear that that is a scheme that isn't working. That's very much reinforced by the analysis from the Gloucester report. My Lords, we don't need a ninth consultation. This has been the FCA's response every time there's another major scandal. It's to have another consultation, and at the end of that consultation, there is something like a freckle of movement. This is an issue that needs to be seized by the scruff of the neck and resolved before more people suffer injuries. The regulator needs to be put on the front foot, and by supporting this concept and this amendment or something very much equivalent to it, the regulator finally gets put onto the front foot and the industry recognises it has been duly warned and must reconsider the way in which it behaves. So I hope very much we will hear from the Minister that at third reading we will see an equivalent to this, because if not, I should not hesitate to ask all of my colleagues and every member of your Lordship's House to support any decision by Lord Stevenson to move this to a division. I call Lord Eatwell.
My Lords, we have several times during our debates on this bill referred to the success of principle-based regulation in this country and contrasted with the more prescriptive regulatory structures introduced within the European Union. The idea of a duty of care is a prime example of principles-based regulation, because it presents a principle from which particular actions can be derived. And it is very important at this time, given the financial stresses that have been created by the pandemic that have been referred to by several noble lords in their contributions to this debate. But this is but one example of the unexpected pressures in the financial system that arise on a regular basis, not least because of fintech innovations referred to earlier, and that require a flexible, principles-based approach. And the strength of a principles-based approach is that it encompasses financial innovations. It encompasses just the changes to which many noble lords have referred. I understand that later in the consideration of this bill, for example, the government will bring forward measures to regulate the buy now, pay later market. But that would have already been encompassed in a duty of care. It would not have, if you like, slipped through the gap. So if there had been a general duty of care in place, consumers would have received some degree of protection already. Now, one of the striking things about the issue of duty of care and the FCA rulebook is that a number of measures which do amount to duty of care exist in the rulebook already. There's Know Your Customers, treating customers fairly, the consumer credit rules set out in the FCA handbook, which require assessment of credit worthiness. But what is striking is that this specific list has gaps within it. Now, many noble lords have referred to the examples of malfeasance, and it is this structure which creates the environment for and encourages malfeasance, because it encourages the testing of the boundaries, the testing of the gaps. And if there were instead a broad principle, then this would be a significant discouragement to that persistent competitive drive to test the gaps which exist within the current list of consumer protection measures within the FCA rulebook. So it isn't simply that the lack of a duty of care creates the inability to deal with malfeasance. It actually creates malfeasance by the structure it presents for a very competitive market. So this particular structure, having a specific list, as we all know, creating a specific list of something in a legal document always raises the question, what's been left out? And that's exactly what is the case in the FCA rulebook today. It lacks the firm foundation of principle. At Grand Committee, the Noble Lady Baroness Penn was quite right to argue, in summing up, that the FCA is already taking steps to ensure that financial services firms exercise due care and regard when offering products, services, and advice to consumers. She was right, there is a list. But she was quite wrong to then argue a statutory duty of care does not add to the FCA's existing powers in this area. Of course it adds. It must add in an industry which is associated with innovation, with change, with competition, with the most dynamic industry, or one of the most dynamic industries in the United Kingdom. It's the very nature of successful principles-based regulation that action should derive from general principles. What the FCA lacks is this statutory declaration of general principle. And that's why, for example, the Macmillan Cancer Care Banking on Change campaign was necessary. And that's why it's so important to place a general principle of duty of care on the statute book. My noble friend Lord Stevenson has made a very specific offer to the noble lady with respect to third reading. I would strongly urge her to accept that offer.
Minister Baroness Penn.
My Lords, I'm grateful to noble lords who have put forward this amendment and appreciate the strength of feeling that exists around this important issue. I would also like to pay tribute to the arguments made in previous stages of this bill, including at Grand Committee. Noble lords have spoken passionately about the need to tackle issues of consumer harm which exist in the financial services industry, and I agree that it is essential that this issue is addressed effectively. The Government is committed to ensuring that financial services consumers are protected and that steps are taken quickly to address issues when they are identified. The noble Lord, Lord Eatwell, has argued for a principles-based approach to financial services regulation. That, my Lords, is what is contained in the FCA's Principles for Business, which govern financial services firms' treatment of their customers, as well as the specific requirements in the FCA's handbook. And I hope noble lords won't mind if I set out those principles of business for them today, because I think that will help us in considering this amendment. The principles include that a firm must conduct its business with integrity, a firm must conduct its business with due skill, care and diligence, a firm must pay due regard to the interests of its customers and treat them fairly. A firm must pay due regard to the information needs of its clients and communicate information to them in a way which is clear, fair and not misleading. A firm must manage conflicts of interest fairly, both between itself and its customers and between a customer and another client. And a firm must take reasonable care to ensure the suitability of its advice and discretionary decisions for any customer who is entitled to rely upon its judgment. These fundamental principles aim to protect consumers who often have less knowledge and expertise than the firms providing them services. The FCA has recourse to disciplinary action, including public censure and financial penalties against firms that breach these principles. And these are not hypothetical powers. The FCA has a long history of imposing sanctions on firms that breach the principles. In September 2019, for example, the FCA imposed a penalty of almost £24 million on the Prudential Assurance Company after it breached the principles, including the principle that firms must pay due regard to customers' interests and treat them fairly. While the FCA's principles set the standards of how firms should treat their customers, and the FCA's enforcement powers allow it to ensure that these are met, the FCA does recognise the level of harm in markets is still too high and is committed to identifying and addressing this. While the coronavirus pandemic has caused the FCA to delay the next stage of this work, it has remained a priority, and the FCA has announced that it will publish a consultation in May. This consultation will explore how the FCA could strengthen and clarify firms' duties to consumers in order to reduce consumer harm. Specifically, the FCA will review its principles and how it applies them in practice, and whether the way that firms have responded to the principles is sufficient to ensure that consumers have the right protections and get the right outcomes. The FCA expects to announce the next steps following that consultation by the end of the year. I should also emphasise that the FCA is undertaking extensive work more broadly to ensure that all consumers, including those who are vulnerable, are protected. In February, the FCA published guidance on how firms should treat vulnerable consumers to ensure they are compliant with their obligations under treating customers fairly. In conclusion, my Lords, I want to reassure the House that the Government recognises the strength of feeling and agrees that it's critical to ensure that consumers are protected. The Government does believe that the FCA already has the necessary powers and is acting to ensure that sufficient protections are in place for consumers without the need to impose a duty of care or expanding the consumer protection objective. The Noble Lord Sharkey quoted FCA evidence to the Liaison Committee last week on the effectiveness of the treating customers fairly principle of business as a point contrary to this. However, this is exactly the subject of the FCA's forthcoming consultation. The Noble Lord Stevenson asked that the Government look specifically at the wording in Part 2 of his amendment and consider how it could take that sentiment forwards. To address a couple of those points on vulnerable customers, as I've just said, the FCA is undertaking extensive work to ensure that all consumers, including those who are vulnerable, are protected. One of the key areas of focus of the FCA's 2020-2021 business plan is ensuring that the most vulnerable are protected. And as I've said, the FCA has recently published new guidance on how firms can treat vulnerable customers fairly. And on ensuring firms that do not take advantage of behavioural biases, the FCA's principles of business already include the principles that a firm must conduct its business with integrity and must pay due regard to the interests of customers and treat them fairly. The FCA recognises that behavioural biases and vulnerabilities can drive consumer harm, and therefore in its 2018 publication, Approach to Consumers, the FCA set out its expectation that all firms should frame decisions for customers based on real consumer behaviour, should not mislead them or exploit behavioural biases. And in order to better understand this area, the FCA has undertaken extensive research to identify areas for concern. For example, a research paper published by the FCA in 2020, which examined the use of online experiments to create behaviourally informed consumer policy. This has allowed the FCA to better account for how behavioural biases impact their work when introducing rules or remedies to protect consumers. And this research has already been applied in numerous areas of FCA policy. and has resulted in concrete action against firms which have exploited consumers' biases and constrained choice. For example, the FCA has introduced new rules in April 2020 on overdraft pricing, which took into account the fact that complex charging structures and high charges had previously been used to take advantage of consumer bias. These rules include stopping firms from charging higher prices for unarranged overdrafts than for arranged overdrafts, and requiring banks to do more to identify customers who are showing signs of financial strain. Could I also directly address the accusation that the FCA prioritises its competition objective over consumer protection? The FCA has 3 operational objectives which have equal standing in legislation. These are to secure an appropriate degree of protection for consumers, to protect and enhance the integrity of the UK financial system, and to promote effective competition in the interests of consumers. And I would like to reassure Noble Lords that the FCA balances these objectives evenly and applies them in concert to achieve the best outcome for consumers. In this sense, the 3 objectives are interconnected and all contribute to protecting consumers from harm, and the FCA's 2017 mission sets out more detail on how these 3 objectives are applied through decision-making frameworks. It does not believe that the consumer objective can be delivered through competition alone, nor that competition should be prioritised over consumer protection. My Lords, the Government will continue to work closely with the FCA to ensure that the concerns raised by this House can be addressed. However, my Lords, I'm afraid that I cannot commit to return to this issue at third reading, and so if the Noble Lord Stevenson wishes to test the will of the House on this issue, the matter to do so is now. Nonetheless, I hope he may reconsider and instead withdraw his amendment.
I call Lord Stevenson of Balmacara.
Well, my Lords, thank you very much indeed for a very good debate. I think this has been a fine example of the way in which report stage brings together the arguments made at committee and allows the House to come to a collective view about where the issue lies in relation to the aspects of the bill that we're considering. The Noble Baroness Penn, in a customary way, gave us a very full and very considered response, and I thank her for that. She did, I think, focus more on what she called the strength of feeling in the House, and she didn't really, I think, engage with the strength of the argument. And I hope that when she comes to reflect on that, she might recognise that's a bit of a weakness here. The arguments are not to be ignored simply because they are expressed strongly. They're to be looked at very seriously because they're trying to attack a problem which is pernicious and is affecting consumer detriment to a huge extent, as exemplified by the many speeches we've had today, particularly from those who've worked in this industry for a number of years. Baroness Altman and others gave examples that were redolent of the experience of trying to make the system work. She also, I think, accepted in her speech that the government did wish to see the regulatory structure protect consumers, and she also said that the level of harm was perhaps too high. And I think in explaining how the 3 objectives that the FCA are expected to operate to, which must be a logical mess when you analyse them down, it does explain why it is that my noble friend Lord Eatwell and others have expressed the wish that we had a better principle-based structure and a less list-based structure for the way in which the regulators carry out the work. As Lord Sharkey put it, and he couldn't put it more simply than this, FSMA does not protect consumers. Malfeasance is flourishing and indeed may be encouraged by the current structure, and redress is patchy, lengthy, and not really available to those who need it most. The issue, therefore, before the House is the question of whether or not the existing process and procedures, the existing wording which sets those out, and the existing objectives which are constraining what the FCA can and cannot do, are the best we can get to. And I think the arguments that have been made, particularly the devastating figures from the Ombudsman Service, do suggest that we are not in a good place on this, and this was picked up by many people, including Baroness Tyler and Baroness Kramer. So in a context of a need for better financial well-being as we recover from the pandemic, the chance to do things better, are we really saying that the best we can come up with is to wait for another consultation, which will probably just be another exercise in playing catch-up and a longer list of rules and requirements? Why don't we just set a very high tide mark for what we expect our regulators to do? And if the consultation proves it to be the case, reduce the requirements where that is proportionate and appropriate to do so. I don't understand why the Noble Baroness felt unable to take away this issue and talk about it and come back at third reading. And she challenged us to put our views to the House. And I therefore would like to test the opinion of the House in this matter.
I shall now put the question. We have heard a member taking part remotely say they wish to divide the House in support of this amendment, and I will take that into account. The question is that Amendment 1 be agreed to. As many as of that opinion will say content. The contrary, not content. The question will be decided by a remote division. I instruct the clerk to start a remote division. Open. Members are now invited to record their votes using the remote voting system. Members will have 10 minutes to record their votes. I will make an announcement when the remote voting period has ended. Clear the bar. It's finished. I will announce the results as soon as possible. Now announce the result of the remote division. The question was that Amendment 1 be agreed to. There have voted contents 296, not content 255, so the contents have it. We now move to the group consisting of Amendment 2. Anyone wishing to press this amendment to a division must make that clear in debate. After Clause 5, Amendment 2, Baroness Bowles of Berkhamsted.
My Lords, this amendment is an evolution of the amendment that I tabled during committee and called the skilled person review of the regulators, and I thank the noble Lord Seeker for signing my amendment at this report stage. Since committee, I have received growing expressions of interest in the concept as an important process for improving financial service regulation. Indeed, one that could be replicated for other systemic regulators. And my purpose today is further exploration. I have reframed the amendment to be an independent persons review via a new Section 1SA in FUSMA that broadly follows the format and definitions already in FUSMA Section 1S. Under Section 1S, the Treasury can establish an independent person review of the FCA. However, it has not been deployed as a routine matter, but rather to deal ad hoc with specific instances, as have reviews under Section 77. My new Section 1SA provides for general review by at least 3 independent persons and to take place after every 2 to 3 years. That period was chosen so that it could be flexed around when there were changes in appointments at the regulators, and it also broadly reflects the 2-year cycle envisaged in Australia for their Financial Regulator Oversight Board, and also the EU's 3-yearly reviews of the ESAs. Today, the ABI have circulated a note supporting the idea, but they think that a longer period might be better, indeed, as I had first proposed. I also added to the list of regulators subject to the review to cover not only the PRA and the FCA, but also the Bank of England for its other regulatory functions and the Payment Systems Regulator. I did that on the suggestion of UK Finance, which has also taken an interest in my amendment as potentially filling a gap in accountability. They had argued in response to the Treasury's Framework Review consultation that covering all banking and finance regulators is needed for a coherent and consistent approach to the whole sector, while structural changes are breaking down the distinctions within it. I thought that a fair point and have included it as food for thought. The list of issues for review are largely taken from the matters found to be at fault in the Gloucester report, such as internal operations and controls, responding to whistleblowers, regulatory perimeter and skills of staff, and also covers effectiveness of rules and regulatory burdens, which it is important to study periodically as a check. But it's important to note that I am not proposing some kind of routine second-guessing on rules as they are made, but more like an impact assessment after they have bedded in. A long list may not be needed and could perhaps be left to the independent persons to prioritise, but one other addition I have made is to follow up on any other intervening review. The amendment also provides a similar right to information and documents as a Section 1S review would have by adding the new Section 1SA to the existing provision in FSMA Section 1T. In the bill, in the clauses that immediately precede this amendment, the PRA and the FCA are each given power to make all the policy and rules for financial services, save for the broad public interest objectives and have regards measures defined in FSMA. The way that is done front-runs the conclusion of the future regulatory framework consultations, and I see two consequences from that. One consequence, which is conceded in the government's consultation, is that Parliament will want to undertake additional scrutiny, and we are dealing with that in later amendments, and it's urgent. A second consequence is that we are conferring a lot more power on our regulators, one of which has been the subject of a flow of negative findings. This amendment is not intended to address the first consequence or in any way diminish the constitutional position of the Parliament regarding scrutiny, indeed far from it. It is meant to address the second consequence, and it also replaces some of the scrutiny that happened by the EU, which included 3 yearly reviews of the European supervisory authorities. With the present ad hoc reviews of failure, the regulator may or may not reform itself adequately. We just have to hope that it does. That is what Dame Elizabeth Gloucester said to the Treasury Select Committee. And she also said that she was not a management consultant who could implement those changes. Regrettably, I don't think the Treasury Select Committee or other committees of Parliament are in that position either. No matter how frequently the regulators may send reports on their activity or senior executives appear before committees, does Parliament have the capacity to do the type of inspection that is gained in an independent review? And if it can, then why do we keep having to have ad hoc reviews? The parliamentary system may work well for scrutiny of rules against policy objectives and for pointing out where review into failure is needed, but it is harder to look systematically at what goes on in terms of operations and controls, the skills base of staff, or how well change management has been brought about. For that, the word of the chair and executives has to be taken, and in all earnestness, I am sure they believe they have done a good job and won't say otherwise. But in business, the value of outside eyes is well known, and the regulators also use that in supervision. So that is where there is a gap that that regular independent reviews fill. And if the basic concept is accepted, then it could indeed be done in other ways. But what is needed is the will to review for quality control and not just after fault is known. Before finishing, and because this is the first amendment at report stage dealing with oversight arrangements, I will very briefly reference, as others may, that since committee we have had letters from the regulators that broadly lay out how they see accountability at present. The content is somewhat disappointing given that the Parliament's debates and suggestions have hardly been secret. And I would say it's unbalanced for government and regulators to grab front-running positions in which constitutional power is removed from Parliament, for that is what removing the statutory instrument layer does, and not simultaneously pledge to restore equivalent constitutional rights. But returning to the present amendment, although financial regulation, supervisory processes and oversight have been worked through on previous occasions, they do not yet work, or are not yet being worked, so as to keep things up to scratch. And having regular independent review is something that can fill that gap and have a place within the future regulatory framework. I beg to move.
Amendment proposed. After Clause 5, insert the new clause as printed on the Marshall list. I call the next speaker, Lord Davis of Brixton.
My Lords, the issue that I want to highlight, as I did at the earlier stage of the bill's progress, is how to make regulators more accountable given the well-established experience phenomenon of regulatory capture. Regulatory capture is where an industry regulator, like the FCA and the other bodies mentioned in the amendment, comes to be dominated by the industry it's charged with regulating. The result is that the agency, which is meant to be acting in the public interest, instead works in ways that benefit the industry. I don't think there's any doubt that this happens. The question is, what do we do about it? The important point to understand that this doesn't happen because of inadequate or effective or corrupt individuals. It happens because it's systemic, it's institutional, it's not an individual problem. Various reasons why it happens. A regulated industry has a keen and immediate interest in influencing the regulator, whereas the customers are less motivated. They have normal lives to lead, and they are only engaged with the industry for brief periods, whereas the participants in the industry are there all the time. Secondly, industries tend to devote large budgets to influencing the regulator, and this is bound inevitably to have an impact. And thirdly, there's the whole industry community aspect. People do tend to move from regulator to industry to regulator, and that is bound to have the personal relationships that are established is bound to have some impact. So there's no question that this phenomenon exists, how bad it gets, and what we do about it is what we need to address. The first step, of course, is to acknowledge the problem, to recognise and address the challenge. The next step is to make the regulators as accountable as possible, which poses the question, who regulates the regulators? There are many ways of doing this, but what we have before us today is Amendment 2, a periodic independent review of regulators. What I have in mind is something akin to a school inspection. This doesn't happen because the school has demonstrated problems. It's just part and parcel of a regular process that focuses the minds of all those involved. At the moment, regulating the regulars is effectively left to the government and left to the government whenever it cares to turn its mind to the issue. The problem here is that governments have many other things to think about, and the result is that it only tends to happen after the problem has arisen. Public becomes aware that there is some deficiency in the regulator, and so action has to be taken. How much better it would be to pose the questions as to how the system can be improved before we encounter the problems. And that only happens through a regular independent review under the terms of this amendment. Thank you.
Call Baroness Noakes.
My Lords, this is the first time I've spoken at this report stage, and I draw the attention of the House to my interests set out in the Register of Interest, in particular shares that I hold in listed financial services companies. My Lords, I have considerable sympathy for this amendment because the financial regulators are not very accountable. At the moment, there are set-piece appearances before the Treasury Select Committee in the other place, and occasional appearances before committees of your Lordship's House, but these do not amount to a systematic and comprehensive examination. The Government often rely on the fact that annual reports are laid before Parliament, but I believe that annual reports of regulators get no more attention paid to them than do the annual reports of companies. With rare exceptions, they provide few insights of value. And by their very nature, annual reports accentuate the positive and shy away from the negative. The problem of accountability of regulators is not confined to financial services regulators. I could say much the same sort of thing about Ofcom, about Ofgem, and about other regulators, but we can't solve the problems of the world in this bill. The question of the regulators and the accountability of the PRA and the FCA is covered in the future regulatory framework, which is the consultation which has fairly recently been completed. And we discussed this a little on our first committee day, and I hope that my noble friend the Minister will give some information on the next steps when he responds to this amendment. The consultation closed over a month ago, and the Treasury must have some idea on what they will be doing next and when. If the outcome of that review, as far as accountability is concerned, is a well-developed form of parliamentary scrutiny, either jointly between both Houses of Parliament or within each House, the need for an independent review clause, such as in Amendment 2, would, I believe, recede. I believe that parliamentary committees can look at issues in depth, but only if they are properly focused and are well-resourced. On that basis, I think the Noble Baroness Lady Bowles of Berkhamsted might want to await the legislation which will implement the outcome of that review, rather than tackle the issue in this particular bit of legislation, because then it could be set in a broader, more holistic concept of how the regulators will be operating overall in due course. My Lords, if the Noble Baroness Lady Bowles does want to pursue her amendment, and I think I heard her say it was actually more of a probing amendment for today, I think it would be wise to look again at its drafting, because it calls for one review covering 4 regulators. But those regulators are very different in what they do and how they do it. And I'm not convinced there will be sufficient focus if one review tried to cover all 4 regulators, the 2 major regulators, and then the 2 smaller regulatory responsibilities, one in the Bank of England and one in the Payment Services Regulator, which is within the FCA. In addition, I, like the ABI, wondered whether every 2 or 3 years is too frequent for the kind of in-depth review that the Noble Baroness Lady Bowles has in mind. And in my terms, a rolling series of reviews, perhaps carried out over 5 years, but concentrating on individual regulators, would give more information of value to those seeking to hold the regulators to account. But the Noble Baroness Lady Bowles has the right ideas in this amendment, though it may not be right for this bill.
Lord Seeker.
My Lords, it is a great pleasure to support Amendment number 2. Throughout the earlier stages of the bill, a number of noble lords have drawn attention to the failures of financial regulators. Essentially, it is argued that they are captured by the finance industry and therefore advance its interests. They are too slow to protect people from malpractices. Over the years, numerous financial products have been fraudulently sold. These include pensions, endowment mortgages, precipice bonds, split capital investment trusts, interest rate swaps, payment protection insurance, and much more. The name of the product changes, from the aforementioned to mini bonds and supply chain finance, but the basic problems are still the same. And regulators have actually failed to secure positive changes in the culture of financial services enterprises. During debates, ministers have emphasized the tax contribution of the finance industry, but have been silent on the costs imposed by the finance industry on society. Scholarly research shows that between 1995 and 2015, the oversized and scandal-ridden finance industry made a negative contribution of £4,500 billion to the UK economy, which is equivalent to around £67,500 for every woman, man and child in the UK. After £4,500 billion, £2,700 billion is accounted for by the misallocation of resources, where resources, skills and investments are diverted away from productive non-financial activities to the financial sector. The other £1,800 billion arises from the 2007 and 8 banking crisis, which ushered in never-ending austerity. And indeed, the economy and most people are yet to recover from it. £4,500 billion is a massive cost, and we simply can't afford it. Therefore, status quo is not really tenable. It is just too expensive. The cost of the finance curse upon the UK cannot be reduced by carrying on the regulatory business as usual, which is what the government seemed to indicate during the committee stages of the bill. Our regulators need to be effective and proactive, but they seem to neglect their duty to the people. This is well documented in the reports on London Capital and Finance and Connaught Income Fund. The FCA knew that mini bonds were a problem, but it was too slow to act at London Capital and Finance, and the same pattern has now been repeated at Blackmore Bond. The FCA does not welcome public scrutiny. Just look at the excuses that it concocted to conceal the reports on frauds at HBOS. The saga is still not resolved, and the same goes for frauds at RBS. It is well documented that thousands of people are trapped in the £3.7 billion collapse of the Woodford Investment Management. The Woodford Equity Income Fund was first authorised by the FCA in 2014. In 2015, the FCA was informed about its precarious existence, as it was making excessive investment in unlisted securities which affected its liquidity. But the FCA ignored the information until at least 2017. The Woodford Empire was able to manufacture compliance with the FCA rules by treating investments in securities partially listed on the Guernsey Stock Exchange as liquid. Guernsey stock market is incredibly thin, and indeed many of the securities held by Woodford had no trade at all for quite some time, yet they were still treated as liquid. Over the last 3 years of its life, 4 of the firms in which Woodford invested issued preference shares in Guernsey, but there was actually no trade at all in those shares. This simple trick of having securities listed on an obscure stock exchange enabled Woodford to classify them as liquid rather than illiquid and flatter its balance sheet and manufacture compliance with the FCA and the PRA rules. They took no action. The FCA and PRA continue to manage by numbers and did not drill down to see what these numbers actually represented. We are still awaiting an independent inquiry into the FCA's handling of the Woodford collapse. Too many corrupt practices also fall between regulatory stools. The noble Baroness Lady Bowles of Berkhamsted mentioned a number of regulators. I have counted at least 41 regulators, maybe there are more, who are connected with the world of finance. That is simply too many. And that needs to be looked at as well. But nevertheless, matters continue to fall in between the stools. There is considerable evidence showing that the banks have forged customers' signatures. The FCA has done nothing. Or is that really a job for the National Economic Crime Centre, or the NECC, which has done nothing about these cases either? The NECC was launched in October 2018 and is yet to prosecute a single case. In September 2020, the FCA failed to secure its first criminal conviction, a case against Konstantin Vishnayak, a former banker at Russia's VTB Bank, for alleged destruction of records relating to insider dealings. So maybe it is evident that our regulators are not properly equipped by law. They probably don't have enough financial resources. And this is a good reason to have the review proposed in this particular amendment. The FCA has levied a few fines for misconduct, but no company or board of directors is actually held responsible. The biggest losers from this inertia, this inactivity, are really the ordinary people who thought regulators were there to protect them. There is a total failure by our regulators to take robust action. It is often said that those who do not learn from history are doomed to repeat it. So it is the case with our financial regulators. For years, the problem of supply chain finance, also known as reverse factoring, has been highlighted. It was highlighted again by the collapse of Carillion. And if I may just declare an interest here, I was advisor to the Work and Pensions Committee for its investigation of Carillion. Supply chain finance or reverse factoring is a popular method of finance because there is little transparency about it. This source of finance is mostly classified as trade payables or other payables rather than debt. This understates leverage and hence the financial risk of a business. The FCA was required to ensure that Carillion did not provide misleading information to investors in the market, but it was actually asleep and it was not really alert to financial engineering at all. The other side of the equation is in the balance sheet of the banks, providing this source of finance, and the FCA and the PRA do not appear to appreciate the impact of supply chain finance on the balance sheet of banks. The parliamentary report on Carillion drew attention to the dangers of supply chain finance, but that did not spur the government into action. There was no urgency by the FCA or the PRA either, long used to managing regulation by numbers. Were they aware of the impact of reverse factoring on the balance sheet of Greensill Capital and other banks? They needed to examine the business model of Greensill. Did they? The stress and capital adequacy tests can't just be number crunching exercises. Greensill episode draws attention to the qualitative aspects of financial risks, and that again seems to have been ignored. My lords, almost every week there is another financial scandal, and I just mentioned 2 or 3 in passing now. The scandals are man-made and are the outcome of failed institutional structures and the absence of effective democratic oversight. Scandals can be checked and require a new approach to regulation, as has been very ably argued by the noble Baroness Bowles of Berkhamsted. This amendment seeks to guide the FCA, the PRA, and other regulators through external reviews. The focus is on their conduct and whether they are fit for the purpose of meeting their statutory duties, or indeed whether the statutory duties are inadequate for protecting the people. The review would focus upon all kinds of resources which the regulators need. The review would be laid before Parliament and would become a key mechanism for building trust in regulatory bodies to ensure that they carry out their main mission, which above all should be to protect people from malpractices. Thank you.
Call the next speaker, Baroness Kramer.
My Lords, Baroness Bowles has already indicated that she doesn't intend to move or to call a division on this amendment, which I think is entirely right. But I have to say, I think it's probably one of the most important amendments that we have discussed under the umbrella of the Financial Services Bill, because it opens up a new area to consider, I think, which is how we make our regulators accountable, and whether or not the committee system and the kind of traditional structures of Parliament can do the whole job, or whether or not they need support from some additional bodies, an outside pair of eyes, I think Lord Davies said in discussing this issue, that whether or not an outside pair of eyes could be extremely useful to Parliament, bringing a particular expertise, reviews on a periodic basis, not looking, for example, at the decisions made by the regulator, but its capacity and its mode of operation, and those absolutely core issues which determine whether or not a regulator is effective. Again, Lord Davies, I think, compared it to a visit from Ofsted. That's probably a little light touch and simple, but I think it takes the conversation in the right direction. I have a very strong suspicion that 3 or 4 years from now, we will be back to this discussion and looking very much at an independent arrangement to look at our various regulators in order to provide information when appropriate to Parliament so that it can get on with the areas of scrutiny in which it has most capacity, which is to make sure that the rules actually fit with the mandate that Parliament has given it in primary legislation. So I think this is an extremely important area, some very interesting thinking, and I hope that Treasury will take note. Be lovely if it was picked up in the financial framework review, but that might be hoping for too much. That review has gone a very limited and very traditional route, and I think that it would be good to challenge it with some new thinking and to try and open its process to really breaking through and working out how accountability in a very effective manner can be put in place. Because this affects our fundamental economy. It affects the capacity of a government to deliver on public services. So the consequences are very significant. And so I think real attention paid to this area would be exceedingly welcome. My Lords, I won't pick up the other scrutiny issues because we're going to deal with those on the second day of report, and that's when I will turn and discuss some of the letters that we have had from the regulators. But I do want to put down a marker that this is an area that should be taken seriously, a thought process that needs to be taken seriously, and I hope the government will see that as an opportunity.
I'd like to call the next speaker, Lord Eatwell.
My Lords, I was tempted to start my speech with the famous quotation from Juvenal on who guards the guardians. But given the strictures by the leader of another place against speaking in foreign languages, although he was referring to Welsh, I will instead begin by taking a different quotation, one from the noble Lord, the late noble Lord, Lord Keynes. Keynes, in his introduction to his general theory of employment, interest and money, says, "It is astonishing what foolish things one can temporarily believe if one thinks too long alone, particularly in economics." Now, we've certainly had many examples of regulators believing foolish things. For example, the sorry history of the regulatory response to the role of credit derivatives in the expansion of credit in the run-up to the financial crisis of 2007-2009 is a clear example of such a folly of thinking alone. Hence, a periodic review of the thinking of regulators, whether the prudential regulator or the conduct of business regulator, would certainly be worthwhile. It would be a useful challenge to group think. However, I don't think this particular aspect is best achieved by 3 independent persons, because there would be a grave temptation to appoint 3 expert regulators, just the sort of people who would think in the same way. And however, they would no doubt come up with recommendations which deal with the operational objectives in this amendment. So I really see the review activity as falling into two parts: the operational assessment and the core policy issues about which I would have less confidence of the approach of the three independent persons. Because peer reviews are all very well, but I can assure you that any academic economist will tell you that peer reviews not only tend to embody the status quo, they often stifle innovation and can perpetuate error. And that's why I and others in the House have argued that the intention of this amendment with respect to policy would be best met by a parliamentary scrutiny committee. It is because it is the nature of parliamentarians to be sceptical, to pose without embarrassment the naive question, to entertain the views of mavericks and free thinkers, and to relate the performance of any organisation to its statutory objectives. After all, they are responsible for the statutes. And so I think really we have two tasks before us. The review as proposed in the amendment, which I think would be a valuable check and assessment of operational matters, and then the review of policy and thinking, which could be the regular component of the work programme of a scrutiny committee. But first, of course, we need the acknowledgement from Her Majesty's Government that they would support the foundation of such a scrutiny committee, giving it appropriate powers to work with the regulators in an effective and constructive manner, and the power to commission regular reviews of policy issues of the sort sought by the noble Lady Baroness Bowles. Now, we are going to discuss this matter later, but I think so much hangs on the issue of the general scrutiny of the activities of regulators, voiced by members on all sides of the House, that we will certainly return to this matter later in consideration of the bill.
I'd like to call the Minister, Earl Howe.
My Lords, as the noble Baroness Lady Bowles has helpfully explained, this amendment seeks to introduce a statutory obligation for the Treasury to launch an independent review of the financial services regulators every 2 or 3 years. It also sets out the topics that such a review would need to cover. Let me begin by saying to the noble Baroness that I absolutely understand where she is coming from in tabling this amendment. Indeed, having yesterday reread the 2 very eloquent speeches she made on the subject in Grand Committee, and indeed having listened to the noble Lord Davis of Brixton today, my mind, like the noble Lord Eatwell's, also turned to the Roman poet Juvenal's famous question. The noble Baroness is concerned about the need for oversight of those who oversee, and I entirely appreciate her reasons for wanting reassurance on that issue. However, where she and I differ is over her contention, express or implicit, that there is currently a deficiency of mechanisms to provide meaningful oversight of the regulators and to ensure that they are working effectively. I set out a number of these mechanisms in Grand Committee. They include tools both for examining detailed operational or policy matters, as well as scrutinising more general overarching issues, which was part of the distinction, I think, that the noble Lord Eatwell was making. As noble lords will be aware, the government appointed Nikhil Ratty as the FCA's CEO in October 2020 and fully supports the ongoing transformation programme that he is leading. This programme will support the FCA's transition to being a data-led regulator capable of taking action quickly and effectively to reduce harm to consumers and markets. More generally, on an ongoing basis, the Economic Secretary to the Treasury frequently meets with the CEOs of the FCA and PRA to discuss both policy and operational matters, whilst of course recognising the independence of those regulators. And this is in addition to the FCA being subject to full audit by the National Audit Office, the NAO, with the NAO having the associated ability to launch value for money studies on the FCA. The NAO has published a number of reports examining the work of the FCA, the PRA, the Payment Systems Regulator, and the Bank of England. Importantly, there are also effective mechanisms for scrutiny of the UK's regulators by international experts. The International Monetary Fund's Financial Sector Assessment Programme, in which the UK participates, sees teams of experts assess, amongst other things, a country's regulatory framework, the quality of its supervision of the financial sector, and the ability of regulators to respond to systemic stress. The findings of these substantial assessments are published by the IMF and provide a highly detailed, independent review of the UK's regulatory system, which I'm concerned that this amendment would risk duplicating. The last assessment was completed in 2016, and another one is currently underway. Turning to the specific points proposed in the amendment that such a report should include, I'd like to reassure the Noble Baroness that such information is already available through both statutory and non-statutory mechanisms. The regulatory perimeter is discussed in an annual dedicated meeting between the Economic Secretary to the Treasury and the FCA Chief Executive, which I believe demonstrates the government's existing capacity to analyse complex regulatory policy issues such as this on an ongoing basis. More broadly, the FCA is required to consult before making changes, and these include changes to its fee structure or to its rules. And it is required to maintain 4 statutory panels to represent the interests of practitioners and consumers, and must consider representations from those panels throughout the policy development process. It must also publish responses to any representations received from the panels. Regarding whistleblowers, the FCA and PRA already have strong protections in place. They've established rules to ensure, first of all, that all employees are encouraged to blow the whistle where they suspect misconduct, and secondly, that they can be confident that their concerns will be considered and that there will be no personal repercussions. The government is confident that the protections already available to whistleblowers in the UK financial services sector are appropriate and proportionate. In addition to these mechanisms to scrutinise and oversee the effectiveness of the regulators, the Treasury has powers under Section 77 of the Financial Services Act to require the FCA to conduct an investigation into particular events where this is merited. The recent independent review by Dame Elizabeth Gloucester into the FCA's regulation and supervision of London Capital and Finance, or LCF, is one such example. In response to concerns about the FCA's regulation of LCF, Dame Elizabeth's report takes an appropriately forensic approach, considering the full range of relevant factors and identifying 9 recommendations for the FCA. And the FCA's response to that review details the significant steps they have taken and are continuing to take to transform the organisation. These steps include a substantial investment in technology and in skills to further enhance the FCA's operational effectiveness. The FCA have committed to reporting publicly on the progress of this transformation until Dame Elizabeth's recommendations have been substantially implemented. My Lords, we'll return to the important issue of parliamentary scrutiny and accountability in later debates, and I went into some detail on this in my remarks on this amendment in committee. So I hope my noble friend Lady Noakes will forgive me if I just very briefly touch on some of the mechanisms currently available to Parliament. As my noble friend reminded us, the regulators must account for their performance in annual reports to Parliament, explaining how the regulator has discharged its functions in relation to its statutory objectives and how operational objectives have been advanced. The Treasury Select Committee has the opportunity to conduct pre-commencement hearings with the FCA CEO and Chair and senior appointees to the bank, including the Governor and Deputy Governors and members of bank committees. It also regularly holds hearings with these and other senior bank and FCA officials. As noble lords will know, the wider issues around scrutiny and accountability are under the spotlight in the future regulatory framework review. My noble friend Lady Noakes asked me for an update on that. Well, very briefly, the Treasury received 120 responses to our consultation on the future regulatory framework. We're considering these carefully. We will publish a more detailed consultation later this year. And as my noble friend suggests, the government considers this to be the appropriate place to consider any changes to the existing arrangements for scrutiny and oversight of the regulators. So, my lords, given that all I have said, I would contend that the requirement proposed by this amendment to hold such wide-ranging reviews every 2 or 3 years would place a significant time and cost burden on the regulators. And I would equally contend that this would be disproportionate given the mechanisms and processes that already exist to hold the regulators to account and ensure that relevant information is in the public domain. I hope the noble Baroness, on reflection, will agree with that assessment. Skilled oversight can take a number of forms, as she rightly observed in Grand Committee. I've listed those that I think are key, not the least of which, as I've mentioned, is the added degree of transparency to which the new CEO of the FCA has committed himself in response to the Gloucester report. In the light of all I've said, I hope the noble Baroness will feel sufficiently comfortable to withdraw her amendment.
My Lords, I've received no requests to speak after the Minister, so I'm going to go straight back to Baroness Bowles.
My Lords, first, for the purposes of the report stage, I must remind the House of my interests in the register, which I omitted to do when I first spoke today. I thank all noble lords who have spoken in this interesting debate. Lord Davies has reminded us of the effects of regulatory capture and the way that that is just something that is endemic within the system, not least because of the overwhelming volume of meetings and contact that takes place with the industries, both in policy terms and as they are regulated. And as my noble friend Lady Kramer observed, he drew a slight parallel with Ofsted, but there is a point that somebody from outside has to come in. And I agree with the noble Lord Davies that at the moment this really doesn't seem to be something that the government is turning its mind to often enough, because otherwise we wouldn't keep having to have reviews about failure. I thank the noble Baroness Lady Noakes for thinking that I've got the right ideas. I think some of my drafting was maybe a bit adrift. I did mean that each regulator had its own review, and certainly the concept of a rolling review was what I would have had in mind. And I very much agree with the comment that the noble lady made, that set pieces make it difficult to get into the sort of systematic operational review that really lies at the heart of my amendment, even if I accidentally strayed perhaps too widely. And I also agree that annual reports concentrate on the good, and then responses to the report and parliamentary engagement with the report is in fact intended to be via the Treasury. And I think that indirect link is not really satisfactory either as far as Parliament is concerned. The noble Lord Seeker has reminded us of the cost of failures in regulations, and that because of the history and where we're at, really can it be business as usual? And that we have had examples of the FCA making excuses for slowness and failure. Now, I do agree with the Minister that there is a new CEO who I know extremely well, And I thought he made some good points when appearing before the Treasury Select Committee about how he has brought in outside people to bolster, using exactly what I said is the understood way of doing things in business, that you need outside eyes and you take outside eyes. But he's done his best in that sense by bringing some fresh blood into the FCA. But when it comes to parliamentary reports on matters, again, as the Noble Lord Speaker has reminded, parliamentary reports, for example, about Carillion, did not trigger action. So if they don't trigger action, something is missing. The Noble Lady Kramer, I think, has explained exactly where I think that we are, that I am testing the water here. I am exploring and asking, are traditional roles sufficient? And, well, we'll have a little time to see. But like my noble friend, I think that we will be back here in due course. And I think that the Noble Lord Eatwell has also put his finger on the distinctions between operational and policy, and what belongs with Parliament and what would belong with independent review. And I think that that is a useful distinction with which perhaps going forward with these ideas I can take to heart. The Minister has again said that there's plenty going on that where reviews can be done, but the point is they're not being done. They're being done into faults. They are not being done in a systematic way that is quality control. I don't disagree that there may be within legislation sufficient scope to do some that are more like quality control. And if the Minister was saying, well, right, we'll have a look to see whether that can be done more, I might agree. But at the moment, there is a hole. And though he says that it might be expensive, as the Noble Lord Seeker has pointed out, it's very expensive, including on the industry that has to sort of cough up if compensation is needed, and it comes from the central compensation funds, that when things go wrong, it is expensive, and probably more expensive than if one had done the proper quality control monitoring. And really, the IMF and the Basel reviews, these are not, they are not UK-based reviews, and they are not reviews that are debated, if you like, in the public forum within the UK. And I would also point out that they are also reviews done by regulators of regulators, and that is absolutely one of the things that I'm very much trying to get away from. And I agree, again, I think there with the Noble Lord Eatwell. Yes, they have to be skilled people, but no, they jolly well shouldn't be regulators and recent regulators, and maybe not even formal regulators, because otherwise you don't get away from the groupthink. And I'm sorry, IMF and Basel are part of the groupthink. So finally, to close, I mean, I'm interested that there were 220 responses. I think there have been another 6 responses if you take today's discussions into account, as in a sense responding to the future financial structure. And yes, I will admit that I have been introducing an idea that I've sprung upon your lordships, having put it in fact in my own response to the FRF review, and now I have aired it. More people are interested, not just in this House, but also within industry. But it is not something that is urgent, because a periodic review would be, even by my estimations, 2-3 years away, when the new powers have been operated for a while and embedded in, and indeed new parliamentary scrutiny embedded in. But with that spirit, then it may be the fact that I will return with this idea in another bill, maybe after having that next time consulted with other noble lords who have shown an interest, but for now I beg leave to withdraw my amendment.
It's pleasure that this amendment be withdrawn. Amendment by leave withdrawn. Do we need to take a moment to allow people to escape the chamber, or are you all here for the duration? You're all here for the duration. Very good. We'll move straight on. OK, we now come to the group beginning with Amendment 3. Anyone wishing to press this or anything else in this Group 2 division must make that clear in the debate. After Clause 5, Amendment 3, Lord Oates.
My Lords, I declare my interest as the Chairman of the Advisory Board of Webber Shandwick UK. I rise to move Amendment 3 in my name and that of the noble ladies Baroness Hayman, Baroness Jones of Whitchurch and Baroness Altman. In doing so, I thank all the organisations who provided me with briefing, in particular Finance Watch, for their helpful advice and recommendations. Before I speak to Amendment 3, I also want to express my support for other amendments in this group, particularly Amendments 22 and 23 in the name of the noble lady Baroness Hayman, which deal respectively with climate risk reporting and the appointment of a senior FCA manager responsible for climate change, both of which I've been pleased to put my name to. My Lords, during the committee stage of this bill, we had an excellent and productive debate about the impact of climate risk on the financial system and the wider economy. And I'm grateful to the Noble Earl, the Minister, for his careful consideration of the arguments, and to noble friends and colleagues across the House for the excellent cross-party cooperation we have achieved on these issues. I particularly thank the Noble Earl, the Minister, for listening to the arguments on the need for the FCA and PRA to have regard to the UK's 2050 net zero obligations and for introducing government amendments to achieve this end. That is a great step forward. My Lords, if we are effectively to respond to the existential threat that climate change poses to our financial system and indeed our whole human society, finance will be critical in allocating the huge amounts of capital required to decarbonise the global economy. Today, however, finance is the principal enabler of climate change by providing financing for the global warming accelerating activities of the fossil fuel industries at an artificially low cost as a result of inadequate pricing of climate risk within the financial system. As long as capital adequacy risk weights are inconsistently applied within the capital requirement rules so that fossil fuel activities are under-risked, capital will flow towards them because the equity that has to be held on the bank's balance sheet will be less than it should be and the return on equity consequently better than it should be. As a result, capital which could be better employed in the new technologies that we will need to counter climate change will continue to be misallocated to the old industries that drive it. Amendment 3 attempts to address this problem by requiring the PRA to complete a review of capital adequacy risk weightings in relation to existing and new fossil fuel investments within 6 months of the bill being passed. The aim of that review would be to ensure that risk weights for fossil fuel investments adequately take into account the impact of global warming accelerating activities on financial stability, in particular as a result of climate change-related disruption to the economy. This amendment is an attempt to meet the concerns of the Minister over my more direct amendment at committee stage, which called for specific risk weights to be applied to fossil fuel investments in line with the existing capital adequacy rules of the Capital Requirement Regulation, or CRR. The committee stage amendment required the application of a 150% risk weight to existing fossil fuel investment in line with Article 128 of CRR, which requires such a risk weight to be applied to items associated with particularly high risk. For example, hedge funds or investments in immovable property. Clearly, it's hard to argue that fossil fuel investments are less risky than either immovable property or hedge fund investments, given the likelihood of fossil fuel assets becoming partially or wholly stranded. The logic of CRR is therefore that such investments must be included under Article 128. That they are not indicates that the regulatory system is struggling to respond to the complex and related and interrelated risk posed by climate change to the financial system. Secondly, the original amendment proposed that for new fossil fuel exploration and production, a risk weight should be applied such that investment in these activities would have to be backed by 100% equity on the lender's balance sheet. Such a risk weight being merited by the fact that new fossil fuel investments are likely to become entirely stranded, and that exploitation of new fossil fuel investments would push us far beyond the level of 2 degrees of warming, which the Intergovernmental Panel on Climate Change warn us would have enormous and unpredictable consequences for human society, not to mention the banks and the financial system as a whole. It's right in those circumstances that resulting loss of capital should be effectively ring-fenced so that the problem is confined to the bank equity holders and not allowed to spread to depositors and the wider financial system, adding a financial crisis to a climate crisis. My Lords, it is fair to say that the Minister and a minority of other peers were resistant to the direct approach to risk weights that I proposed. The Noble Earl, the Minister, was concerned, as was the Noble Lady Baroness Noakes, that we were seeking to use prudential regulation to achieve policy objectives which they felt were better pursued elsewhere. The Minister stressed that the system of prudential regulation should be about the risk to the capital of the banks and the soundness of the financial system as a whole, to which I can only say I agree with him. That is the precise purpose of the amendments that I and my noble friends and colleagues across the House have been pursuing. And last week, the Deputy Governor for Prudential Regulation and CEO of the PRA, Sam Wood, stated in a speech to the Association of British Insurers that it is a fundamental pillar of the prudential regime that it is risk-based. Disregarding risk in individual investments is a recipe for an undercapitalised financial system that would not be a robust or sustainable source of investment. I agree with the Deputy Governor, just as I agree with the Minister. My only difficulty is that the disregarding of risk in individual investments, which the Deputy Governor warns us against, is exactly what is happening in respect of fossil fuel investment, because prudential regulation has not worked out how to adequately assess the impacts of climate change on the financial system. The scale of the problem was highlighted by Mark Carney in his Breaking the Tragedy of the Horizon speech some years ago, where he said, take, for example, the IPCC's estimate of a carbon budget that would likely limit global temperature rises to 2 degrees above pre-industrial levels. That budget amounts to between 1/5 and 1/3 of the world's proven reserves of oil, gas and coal. If that estimate is even approximately correct, it would render the vast majorities of reserves stranded. Oil, gas and coal that will be literally unburnable without expensive carbon capture technology, which itself alters fossil fuel economics. The exposure of UK investors to these shifts, he noted, is potentially huge. Is anyone seriously suggesting that these risks are currently being properly taken into account in the capital adequacy risk weights? If they were, it's inconceivable that existing fossil fuel investments would not be ranked under Article 128 of CRR as items associated with particular high risk. And of course, investments in new fossil fuel exploitation pose not only microprudential risks to banks arising from stranded assets, but the huge macroprudential risks due to the acceleration of climate change which they will cause. The Minister sought to reassure us in the debate in committee that the regulators have these matters under control, and he prayed in aid, as did the Noble Baroness Lady Noakes, the climate scenario tests that the bank will be conducting later in the year. These are no doubt worthwhile exercises, and it's good to see that the bank is setting the international pace. But these scenario tests will not fix the issue, because although the Governor of the bank implicitly recognises the role that capital adequacy requirements need to play in addressing climate-associated risks, when he says that supervisory expectations will require firms to assess how climate risks could impact their businesses and review whether additional capital needs to be held against this, he also states that in relation to the climate scenario test, that the bank will not use them to size firms' capital buffers. The reason that the bank is reluctant to do so is because of the difficulty of using such tests to measure hard-to-quantify future risk. So we have a dangerous scenario when regulators say they can't act until they can adequately measure risk, and on the other hand, that the risk is too difficult to measure. The route through this is to apply the existing capital adequacy risk weights in an internally consistent manner, as proposed by the amendment that we put at committee. However, although I stand by that position because I believe it's the only logically coherent and feasible way of dealing with risk in respect of fossil fuel activities, I have listened to the Minister's arguments and those of the Noble Baroness, and consequently I have put forward this revised amendment to require the PRA instead to conduct a review of the issue of risk weights and climate change and report back to the House. This will provide an opportunity to carefully consider the issues raised and also to inform the debate on risk weights at international level. I hope the Minister will see merit in this proposal. My Lords, as I made clear at committee stage, and I stress again report, that neither my amendments now nor the revised version before your Lordships today is driven by any animus against the fossil fuel industries, quite the contrary. I have a huge respect for the people working in those industries and a huge determination that there should be a just transition for those employees as we decarbonise our economy. We will be able to achieve that much more easily if the financial system shepherds an orderly transition away from fossil fuel industries through the appropriate application of risk in the system. My Lords, I understand the reluctance of government to intervene in prudential regulation, but ministers cannot abdicate responsibility, and they must not cling to the idea that the technicians have got this under control, because it is an illusion, and it is an illusion that will have disastrous consequences if it is not corrected. When the system of prudential regulation is so evidently failing in its primary task of managing and controlling risk in the financial system, at least in respect of climate risks, then there is an obligation to act. So I'm hopeful that, having listened to the arguments during the debate, the Minister will accept the case for the review and provide sufficient assurance that this will be taken forward in a timely manner. However, if he's not able to do so, I give notice of my intention to test the opinion of the House. My Lords, I beg to move.
Amendment proposed, after Clause 5, insert the new clause as printed on the marshalled list. I'd like to call the next speaker, Baroness Hayman.
My Lords, I remind the House of my interests as co-chair of Peers for the Planet. I have amendments 22 and 23 in this group, and will also speak to the government amendments and Baroness Bennett's Amendment 44. I've added my name to Amendment 3, to which the Noble Lord, Lord Oakes, has just spoken so powerfully. But before I speak to any of the amendments, could I thank colleagues, Lord Oates, Baroness Jones, and Baroness Altman and Baroness Bennett, who have added their names to my amendments. And could I thank very particularly the Noble Lord, the Minister, and his team for their very approachable actions in relation to discussions since committee stage. They have been engaged in a sensitive and a constructive way, and as we have come to expect from the Noble Earl, he has always been both extremely courteous and endlessly patient and generous with his time, and I think we've made real progress because of that. My Lords, turning to Amendment 3, which was very clearly and, as I say, forcefully introduced by the Noble Lord, Lord Oates, on the review of capital adequacy risk weighting. And Lords, the Climate Change Committee's advisory group on finance recent report, The Road to Net Zero, made clear the need to, I quote, shift the mindset from managing climate risks to aligning finance with net zero, and quotes, make real economy policies investable to attract capital. One of the key ways to achieve this would be to address the issue of capital risk weightings by recognising the extremely high risk of investments in new and existing fossil fuel extraction becoming stranded. We don't currently recognise this in the system in the way we attach capital risk weightings, and as a result, financial institutions continue to invest trillions into fossil fuels $2.7 trillion since the Paris Agreement. This amendment asks that a review of fossil fuel risk weightings be carried out in order to consider the full implications of climate change and how it could affect the overall stability of the financial system. My Lords, the Noble Lord Oates has made changes to the amendment, taking into account, as he said, the criticisms and arguments made at committee stage. The situation is urgent. I fear that we don't have the time to allow the market to adjust by itself without government action. Only last week, the Met Office announced that CO2 levels had exceeded 417 parts per million, more than 50% above pre-industrial levels, and this is due mainly to fossil fuel burning. So I hope that the Minister will indicate the government's recognition of the importance of this issue and their commitment to looking very carefully at what is a fundamental underpinning and necessary to the transition to a sustainable financial and economic future. Turning to the government amendments, I repeat my gratitude to the Noble Lord, the Minister's approach, and very much welcome the amendments that he has tabled. These measures will ensure that the regulators must have regard to climate change targets when making new regulations. I would be grateful if the Noble Lord, the Minister, could confirm that the provisions will be in place in time for the important changes relating to the Basel 3.1 standards. And I hope too that the Minister will be able to respond positively to Baroness Bennett's Amendment 44, which would add UK biodiversity commitments to the have regard provisions. I recognise, my Lords, that there are difficulties in metrics in this area, but it is an extremely important issue. So I wonder whether the Minister could comment on whether nature-related financial risks could be added to the TCDF obligations. My Lords, these are very significant amendments which will ensure that the bill is no longer, as it was when it came from another place, silent on climate change. But there is a great deal more to be done to ensure that climate change is embedded across the discussion, the decision-making at a systemic level within our financial services industry. And this is what my Amendment 22 attempts to do, to make sure that we have systemic reporting on climate change and proper scrutiny of that reporting, and that climate change is taken properly into account when consulting on changes to prudential regimes. My Lords, it would provide a scrutiny and reporting framework to ensure that the FCA report regularly on how they have evaluated systemic exposure to climate-related financial risks, and that they are scrutinised by Parliament. As the Noble Lord Oates said, the Bank of England's climate stress test exercise for some key institutions is valuable, but we really do need further and systemic reporting to be planned for the future. The European Central Bank is undertaking an economic stress test to gauge the impact of climate change on 4 million companies and 2,000 banks over 30 years. And the preliminary results have identified climate change as, quotes, a major source of systemic risk, particularly for banks with portfolios concentrated on certain economic sectors, close quotes. The Vice President of the ECB also commented that, quote, these results underline the crucial and urgent need to transition to a greener economy to limit the long-term disruption to our economics, businesses, and livelihoods. The UK regulators have a key role to play in ensuring that a long-term systemic approach is adopted to assessing and reporting on climate risk, which is why my amendment calls for a review of the regulators' objectives with a view to including consideration of net zero targets within their remit. We've made the budget statement indicated that the Financial Stability Committee and the MPC would be taking these risks into account and within their remits. And I hope that this will be extended both to the FCB and the PRA. And it would be extremely helpful if the Minister could confirm when the next PRA FCA remit letters will be publicised. But they will alone, even if changed, will not be sufficient to address the challenges of climate change. So will the Minister commit to setting out the strategy and roadmap for how the sector will achieve this? My Lords, Mark Carney recently commented that climate change, quotes, will be the equivalent of a coronavirus crisis every year from the middle of this century, and every year not just a one-off event. So it is an issue that needs to be addressed now. My Lords, this amendment sets out ways in which the direction of travel for regulators to drive the systemic change we need could be achieved. And I hope that the Minister will be able to respond very positively to it. My Lords, I turn finally to my Amendment 23, which mirrors in almost every detail, though again I listened to Lady Noakes and made some changes in it in terms of the board level appointment. But it deals with the important point, which would help to drive the shift in mindset that we need. The financial regulators require financial institutions under the senior managers regime to appoint a senior manager responsible for identifying and managing financial risks from climate change and reporting on it. In discussion with the Minister, I did suggest that even if we didn't include it in the bill, it would be helpful for the regulators themselves to take this step. And therefore, I was extremely pleased when in the letters to which reference has been made earlier, the Chief Executive of the FCA set out his recruitment of an executive sponsor for climate-related risks. This is extremely welcome news. And I recognise that the other comment that was made on the previous amendment, that it should go wider than climate, and I see that the FCA remit would include all of the ESG standards. So that is extremely welcome, and I thank the Minister and the FCA for their work in this area. My Lords, the government has been very clear throughout the passage of this bill and in many other fora in its rhetoric that it understands the overwhelming importance of climate risk. These amendments lay the foundation of turning those words into action, and I hope that the Minister will be able to respond positively to them. Thank you.
I'd like to call the next speaker, Baroness Bennett of Manor Castle.
My Lords, it's a great pleasure to follow the noble Baroness Lady Hayman, who's taking such a brilliant lead on these issues in your Lordship's House. And I thank her for her concentration on biodiversity crisis as well as the climate emergency. And just to reflect on her comments, I hope this is the last time it is up to the House to add in the missing element of climate to a finance bill. And maybe for biodiversity we can proceed even faster. I would also welcome the news from the noble Baroness about the FCA appointments, although of course on the face of the bill, as with Amendment 23, would be better, because that would provide a statutory guarantee that such an appointment would continue. So I speak to Amendment 3, 23 and 44. 44 being in my name, Amendment 3 being in the name of the Noble Lord Oates and others, and 22 and 23 in the name of the Noble Lady Hayman, to which I also attach my name. I'm going to deal with 3, 22 and 23 together. And in doing that, I had cause this morning to reflect back on the work in your Lordship's House by a similarly small and dedicated band on the Medicines and Medical Devices Bill. At that team's heart was the Noble Baroness Lady Cumberledge, author of a recent review often referred to by her name, but actually titled First Do No Harm. Would it be that we could see the financial sector adopting that principle, but instead they continue to pump out funds into destroying the planet at breakneck speed? A report out this morning showed that the world's biggest 60 banks have provided $3.8 trillion worth of financing for fossil fuels companies since the Paris climate deal in 2015, and that comes from an independent report from a coalition of NGOs. When we look at our home sector, UK bank Barclays provides the most fossil fuel financing among all European banks. The finance provided in 2020 was higher than in 2016 or 2017. Now, the report notes that a commitment to be net zero by 2050 has been made by 17 of the 60 banks, but the report describes these pledges as, quote, dangerously weak, half-baked or vague, end quote. It's clear that self-regulation, however much the government might be wedded ideologically to the idea, has not worked. And we are in an emergency. We can't wait. I quote John Fridgens at Banktrack, part of the coalition behind the report, quote, there exists no pathway towards net zero that does not require dealing with bank finance for the fossil industry, fuel industry, right here and right now, end quote. Now, these amendments don't go that far, but they at least set us on the right track. A track to transparency that doesn't require little-funded NGOs to dig well-buried data out of dark corners. Nonetheless, as others have already noted, we have made some progress since committee, and I welcome the government amendments to this group, which reverse its claim made to me during committee that we didn't need a reference to the climate emergency in this bill. So this will, I believe, after last year's Pension Scheme Act, be the second financial bill to start to acknowledge the truth of donut economics, that the economy, all of human life, has to live within planetary limits, which is where I get to my Amendment 44, addressing biodiversity, which is an addition to the government's amendment requiring the FCA to have regard to the carbon target for 2050 when making Part 9C rules. My amendment simply adds another regard to, in this case, to the UK commitment under the UN Convention on Biological Diversity. I referred to planetary limits, and I don't think we're yet focused nearly enough on the fact that the atmospheric carbon dioxide levels, 417 parts per million today, is only one way in which we're outside the donut of sustainability. There's also the collapse of the natural world, as the globe's governments have acknowledged with the Convention on Biological Diversity, to which the UK is, of course, a signatory. Now, I'm not at the moment planning to push this amendment to the vote, despite the extreme urgency in this nation that's at the absolute bottom of global biodiversity rankings, in a world in which none of our globally agreed targets on biodiversity are set to be delivered in 2030. The obvious point to do this would be after we have a UK target, and I'm sure the Noble Earl the Minister is well aware of the broadly backed NGO-driven push to include a 2030 nature target in the Environment Bill. That would provide an ideal element to include in financial regulation. So what is finance doing to biodiversity? I don't think this is an area that's been nearly well enough discussed, and we haven't got the kind of detailed report that I referred to earlier for the climate emergency, at least that I'm aware of. But if we think about the level of destructive economic activity overall, it isn't hard to think of examples. the operation of industrial scale agriculture monoculture, deforestation and trashing of soils, the production of destructive agri-chemicals and fertilisers, which also have massive carbon implications, the financing of fast fashion, the production of artificial fibres, plastics that will choke our seas and fill our rubbish systems, giant factory ships vacuuming up sea life, and heavy trawlers trashing the seabed, with massive carbon implications also. Financing any of these things and many more economic activities is doing harm, massive harm. And as with climate, as the government has acknowledged to at least a limited degree, regulation is essential. Now, we are slowly making progress, my lords, but the stress has to be on the word slow. It's not nearly fast enough. Amendment 3 from the Noble Lord Oates would be a further step forward. It's needed to improve the immediate response. And should it be pushed to the vote, I can promise the Green Group's backing should the Minister not acknowledge the force of the Noble Lord Oates' arguments. Thank you, my lords.
Thank you so much. I call the next speaker, Baroness McIntosh of Pickering.
My Lords, I'm delighted to follow the Noble Lady and contribute to this debate. I very much welcome the amendments in the name of my noble friend, the Minister, the Noble Earl HoL, in this group, and in particular requiring 43, 46, 47 onwards, requiring the FCA to have regard to the carbon target for 2050 when making Part 9C rules as set out. I always listen to what the Noble Lord Oates says for no other reason that we entered the House the same day, so we're the same vintage, so to speak. But I welcome the fact that the government recognises the risks arising from climate change, and I think my noble friend, the Minister, addressed the issue of stranded assets, which is an issue that I share concern over, and the transition plan out of those. I think this was addressed at committee, insofar as my noble friend did say at that stage that the point of this bill is to support a flexible regulatory system rather than respond to that can respond to changing circumstances and developments as they arise. Now, the Noble Lady Baroness Bennett, just in her remarks, spoke about those technologies and forms of energy which can do harm. And it's my personal concern in the earlier group of amendments, Amendment 3, and the others moved so eloquently, may I say, by Baroness Hayman, 22 and 23, and Baroness Bennett in 44, that the focus is very much still on fossil fuels and moving at the earliest possible opportunity and timetable away from fossil fuels. What worries me increasingly is the fixation that we are having with renewables, which on the face of it do seem to be performing extremely well, both onshore and offshore. We've just completed our last piece of work on the EU subcommittee on the environment, and we looked at the ecology of the North Sea. And what is apparent from the evidence we took is the lack of research, particularly in offshore facilities of renewable energy, on the impact on the North Sea ecology, in particularly the marine life, the dolphins, porpoises and whales, the bird life and the whole sea biodiversity. Also, a plea was made that the cumulative impact should be considered and that we should assess and value all the natural capital, not just the ability to create wind, but what we're losing in particular. They put it to us that we should have a consideration of the impact of these renewables, particularly offshore wind, on other users, such as, in this particular case, fisheries and shipping. And mention's been made also as to the work going on in the Basel framework. And I hope that my noble friend, when he comes to sum up this debate, will give us an update, because I am concerned that some of the amendments here, particularly Amendment 3, but others as well, may actually preempt and not have regard to the international work that will help us to understand how climate risk should be considered through the Basel framework and working with our international partners. Now, I pay very close regard to what those such as Mark Carney and the current Deputy Governor of the Bank of England say, but equally I was particularly struck by the remarks of the Noble Lord King of Lothbury in his remarks in the debate on the budget statement, where he expressed concern as regards the new remit requiring the Bank of England to, and I quote, reflect the importance of environmental sustainability and the transition to net zero. And I think it's very important what we're seeking to do here in the context of the Financial Services Bill is to have, as I understand it, a flexible regulatory system, as my noble friend explained, that will be able to respond to circumstances as they develop. And obviously, it is the role of government in this regard to set the policy, not, I would imagine, the role of the regulators. But I stand to be corrected by my noble friend in that regard. So I welcome the opportunity to have this debate. Obviously, in terms of net zero and climate change and environmental sustainability, there will be a move away from fossil fuel. No one has yet explained to me how we're actually going to attempt to fulfill all our energy requirements in what will be virtually all electricity supply to the market. So with those few remarks, I do look forward to my noble friend summing up and bringing together the themes of this little debate. Thank you.
I call the next speaker Baroness Sheehan.
My Lords, it's a pleasure to follow the noble Baroness Lady Mackintosh. My Lords, I'd like to start by thanking the noble Earl, the Minister, for some movement on this issue. His courtesy throughout is an example to all of us, and I do thank him for his correspondence on the issues that I raised at committee, and some of which I will return to later in my contribution. May I also congratulate noble lords who moved amendments on climate risk at committee stage, without which we would not be where we are today. These amendments were cogently argued and evidently persuasive, but only partially so, which is why a number of them have been brought back, albeit slightly amended at report. My Lord, I support Amendment 3 in the name of my noble friend Lord Oates, the noble Baroness Lady Altman, the noble Baroness Lady Hayman, and the noble Baroness Lady Jones of Whitchurch. It makes a strong case with support from across your Lordship's House for a PRA review of the risk weighting applied to investments in existing and new fossil fuel exploration, exploitation and production. Amendment 22, in the name of the noble Baroness Lady Hayman, seeks to embed evaluation of climate-related financial risks and consideration of the impacts of such risks on the stability of the UK financial system into the modus operandi of the FCA and the PRA. Amendment 23, in the name of the noble Baroness Lady Hayman, provides for the appointment of senior manager within the FCA with responsibility for climate change, and the movement on this by the regulator, as outlined by the noble Baroness Lady Hayman earlier in her contribution, is really welcome. And the last amendment, Amendment 44, in the name of the noble Baroness Lady Bennett, makes huge sense in the context of the recent Gupta review, and I hope that the Minister will give it sympathetic consideration. My Lords, I need to say no more about the content of these amendments, as I would only be repeating the excellent contributions of the movers of the amendments. Suffice to say that all three amendments would send the right policy signals that the government means what it says when it speaks of a climate emergency. if adopted. And the right policy signals are sorely needed because presently the signals being received by investors and indeed all sectors of society are confusing and misleading. So we have a government leading on ending the use of coal for power generation, the Powering Past Coal Alliance, and the same government then toying with the idea of granting a license to a new deep coal mine in Cumbria. We have a government that announced in December last year that they will end UK support for fossil fuel projects overseas. I wonder if the Minister can, the Noble Earl, the Minister, can say whether UK Export Finance's support for the controversial East Africa crude oil pipeline, ECOP, extending from Uganda to Tanzania, will be a done deal before the new March deadline just announced. My Lords, just today, we have a garbled press release on supporting vulnerable communities in the North East and Scotland, who will be affected by the transition away from fossil fuels. And this is, in the press release, justified by an unexplained decrease in emissions by the oil and gas sector. And these communities really deserve better. We're told in the same press release that this decrease in emissions will be achieved by a new regime to hand out new licenses to explore for and exploit as yet undiscovered fields. I'm confused. I wonder whether the Minister can shed some light. Could I ask the Minister if he's able to shed any light on whether the government will be bringing forward legislation to align the Oil and Gas Authority's remit to our net zero target and draw a line under the current MER policy of maximising economic revenue? That, my Lords, might serve to remove some of the confusion. How can new licenses be justified when extraction of the oil and gas in our existing fields will take us over our share of emissions to the Paris Agreement? Surely the government, in a climate emergency itself declared, is not relying on reducing emissions via carbon capture, usage and storage, a technology which is unproven at scale. Meanwhile, back in the real world, the NASA website tells us that 2020 was the hottest year since records began. The World Met Office states that 2011 to 2020 was the warmest decade on record. And the warmest 6 years have all been since 2015, 2016, 2019 and 2020 being the top three. The World Met Office's Secretary General, Professor Tallis, said, and I quote, "It is remarkable that temperatures in 2020 were virtually on a par with 2016, which saw one of the strongest El Niño warming events on record. This is a clear indication that the global signal from human-induced climate change is now as powerful as the force of nature." That, my Lord, is a chilling thought. I will, my Lords, end with one last thought. Temperature is just one of the indicators of climate change. The others are greenhouse gas concentrations, ocean heat content, ocean pH, global mean sea level, glacial mass, sea ice extent, and extreme events. All, my Lords, all are moving in the wrong direction. So I hope the Minister will be able to give a satisfactory commitment that climate risk in the financial sector will be satisfactorily legislated for. And in the absence of such assurances, I will support amendments on the issue to put to a division.
Viscount Trenchard.
My Lords, the Noble Lord Oakes and the Noble Baroness Lady Hayman eloquently introduced Amendment 3. We have had much discussion on this matter in committee, but I still consider that such a review would place too heavy a burden, and a disproportionate one at that, on the PRA. I would like to thank my noble friend the Minister for the diligent manner in which he has responded to Noble Lord's concerns about raising the importance of climate change issues in the list of factors to which our regulators must have regard in making rules. The government's credentials as a global leader in the movement away from reliance on fossil fuels is well established and will, I hope, be further enhanced by the G7 meetings and the COP26 conference later this year. However, this should, I believe, be kept in perspective and balanced against the need for economic recovery and the needs of industry. There is no point in pricing what remains of our steel industry out of the market if the result will be an increase in imports from countries which have not adopted energy policies which are as green as ours, especially if the impact on global emissions is negligible. When I first read my noble friend's amendments, I was puzzled because it seemed to me that he was giving with one hand and taking away with the other. And I look forward to his clarification of how Amendments 43, 46, 47 and 49 net off against each other. I am loath to saddle the regulators with increased obligations which go beyond the practices that they have already adopted. The letter from Sam Woods makes clear that climate change is already an important consideration in the PRA's supervision and regulation of banks and insurers under its existing statutory objectives. Similarly, for the FCA, the letter from Nikhil Rathi makes clear that the FCA is committed to help market participants manage the risks from moving to a low-carbon economy and supports the commitment at least to match the ambition of the EU's Sustainable Finance Action Plan in the UK. Since the FCA has already decided to recruit a director with specific responsibility for ESG matters, I do not think Amendment 23, in the name of the noble Baroness Lady Hayman, is necessary. The remit of the senior manager she suggests should be appointed would clash with that of the new director who is already in process of recruitment. I also believe Amendment 22, in the name of the noble Baroness Lady Hayman, goes too far and is too prescriptive. I think my noble friend the Minister was right when he said to the committee on 28th of February, it is important that we act carefully and rationally, consult appropriately with interested parties, and therefore make progress in the right way. He was also right in stating that the changes the bill enables serve to implement a number of vital reforms following the financial crisis. These reforms reinforce the safety and soundness of the UK financial system. Surely, my lords, we should not amend the bill in any way which might prevent us giving effect to updated prudential rules. I also agree that there is no evidence that greener means prudentially safer, at least not yet, and therefore it is not clear that a regulator whose primary objective is the safety and soundness of financial institutions should be burdened with disproportionate climate obligations now, especially at a time when it is essential to maintain and enhance the competitiveness and attractiveness of the UK's financial markets. I think the advice of the ABI that, with regard to individual regulators' objectives and rule-making powers on climate change-related risks, we recommend the need for holistic debate across stakeholders before adding new objectives to the remit of regulators, given the need to balance the various priorities. I believe that my noble friend's amendments strike the right balance, and I will support them. Whilst I agree with the noble Baroness Lady Bennet of Manor Castle that biodiversity is important, I think she wants to go a step too far in her Amendment 44, in also adding this to the FCA's have regards. There are countless other policies that could be added, but if there are too many, they will muddy the waters and distract the FCA from its efficient operation in performing its core duties and objectives.
I call the next speaker Lord Judd.
My Lords, these amendments and indeed this bill are crucial to the future of the United Kingdom. We see repeatedly here in the arguments we've heard deployed the interaction between, on the one hand, the need for financial services to be successful and effective because they play such an important part in ensuring the well-being by which the rest of our society depends. That is beyond question. But we also know that they have implications socially and beyond, which need regulation. This has been well spelled out. I particularly want to focus on Amendment 3, 22, 23, and 44. Because on 3, fossil fuels inevitably have considerable and extensive risks for the climate. There can be no argument about that. And they have great implications in terms of climate change. And therefore, I'm glad to see Amendment 3 grappling with this. On Amendment 22, the amendment deals with the point really I've just made, which is that financial services have risks for the climate and for climate change. And therefore, it is essential to have the right arrangements in place to ensure that those risks, if not eliminated, are minimized. Amendment 23 makes the point which I've often felt strongly about in legislation, that it's sometimes crucial to have a specific person carrying specific responsibility for bringing together the various threads in policy for which we're aiming and to ensure their delivery. And I think it's a good amendment that I'm glad is there. On Amendment 44, I don't share Lord Trenchard's rather dismissive approach. My view is that the noble Baroness Bennett of Manor Castle deserves considerable commendation for having put this amendment down. First reason, we happily join these UN conventions, and our diplomats have usually played a very large part in bringing them about. But we sometimes lack the disciplines in actually following through what they require of us. And I think at this point in our considerations of the bill, it's very appropriate to talk about the convention and the undertakings we have thereby committed ourselves to on biodiversity. And on the issue of biodiversity, I simply find myself dismayed by Lord Trenchard's position, because we are surrounded by a major crisis in biodiversity. The biodiversity of the world is in danger of collapse, and the consequences of that spell very direct implications for the survival of humanity itself. There is an urgency about this situation. But, my lords, in conclusion, I simply would like to make this point. That I said we wanted the financial services to be successful and effective because we recognise their indispensability. But we also must recognise that on the issue of climate change, we are long past the age of the language of rhetoric and theoretical commitment. We have to demonstrate that we have the leverage and the arrangements in place to ensure delivery. Because if we don't ensure delivery on the measures we want to see to protect the climate, we will be party to a cruise towards catastrophe for the global community. It's vital to have these disciplines. These amendments have been spelling out how we can bring those disciplines more acutely to bear.
Baroness Noakes.
My Lords, I shall speak mainly to two of the amendments in this group, namely Amendment 3 and 23. Starting with Amendment 3, I should say that I'm not generally in favour of littering legislation with reviews, though I do confess to having tabled a few amendments of that nature myself in the past. But more substantively, I think that this particular amendment as drafted is a waste of time. I can predict the outcome of the review if this amendment is passed. The PRA will find that banks do not hold any significant investments. That is the wording used in the amendment, in fossil fuel assets, whether linked to existing exploitation and production or to new exploration. And so all of the things mentioned in subsection 2 of the amendment will be irrelevant. Risk weighting applies to the assets that banks hold. Banks' assets will largely be loans of various kinds. Banks do not normally invest in physical assets used by other companies, nor do they invest in shares which own the assets. Banking is fundamentally about lending and not about investing. Noble Lord Oates cited the recent speech by the Deputy Governor talking about prudential regulation being risk-based, which indeed it is. But I think he failed to understand that he was talking to insurers at the time. They do have investments. And this is a fundamental difference between banks and insurers. They have completely different balance sheets. As I said in committee, most borrowing by oil and gas companies will be generic, for example, by way of bond issuance or commercial paper, by one of the companies in a group, and will not be hypothecated to individual assets or groups of assets. Money is fungible and cannot be linked to any specific use. Bank balance sheets might have some leasing arrangements which might be caught by this amendment, but my main point is that the amendment is fundamentally aimed at the wrong target and therefore amounts to not much more than a virtue signalling amendment. My Lords, there is a case for looking holistically at how climate-related financial risk should be reflected in banks' capital requirements, as amendments in this group, in the name of my noble friend the Minister, may achieve in due course. The Bank of England and the PRA are already alert to this and have an extensive programme of work to explore the issues, including the exploratory stress test built around climate change, which will take place this year and which was referred to by the noble Lord Oates. I do not think that the amendments in this group, in the name of my noble friend the Minister, are necessary, but they certainly do no harm in that context. My Lords, noble Lords proposing Amendment number 3 also need to understand that this is not an immediate issue for the prudential capital measurement of banks. Noble Lords might themselves see climate change as an emergency, but there is no emergency embedded in banks' balance sheets. Corporate lending is short to medium term in nature, and it would be very surprising if the Bank of England or other global regulators saw a need for significant near-term adjustment to capital. Even Mark Carney, the High Priest in this area, has not suggested that. My Lords, the other amendment that I wish to speak to in this group is Amendment 23, requiring the FCA to appoint a senior manager with responsibility for climate change. This is certainly an improvement on the amendment tabled at committee, which I criticised, and which required a full member of the FCA's board to be appointed. But I believe that the amendment is still imperfect because it refers to that person having, and I quote, responsibility for climate change. It's not at all clear that responsibility for climate change could have any meaning, as it is not related to any of the general duties or objectives of the FCA as set out in FSMA. In 2019, the PRA introduced a requirement for banks and insurers to allocate climate change responsibilities to one or more of the senior management functions, and that has to be included within their formal statements of responsibilities. Now, the PRA framed that as responsibility for, and I quote, identifying and managing financial risks from climate change. This is a more understandable format than responsibility for climate change. But that kind of format clearly cannot be lifted and shifted directly into the FCA environment without further tailoring about what the FCA is actually expected to do. I also have to say that it is a mystery to me why the movers of this amendment have singled out the FCA rather than the PRA as requiring a senior manager to be appointed. While both are involved in the current work on the impact of climate change, the PRA has been more in the lead on this, and it was the PRA and not the FCA which specified the need for a senior manager to exist in the structures of regulated bodies. The PRA has already nominated one of its executive directors to oversee, and I quote, the Bank of England's work enhancing the financial system's resilience to climate change. The Noble Lady Hayman has noted that there's a new appointment, a slightly lower level, at the FCA, though I think that there is less clarity about what that person will actually be doing in relation to climate change. Now, I am not convinced that anything is actually required in statute, given that both bodies have moved towards identifying individuals with responsibility in this area. But I do think that if the movers of this amendment wish to take it forward, they should be looking much more carefully about how it is actually drafted.
I call the next speaker Lord Holmes of Richmond.
My Lords, it's a pleasure to follow my noble friend Baroness Noakes. In essence, as we're in a financial services report stage debate, this group of amendments can be summed up rightly, I hope, as what point profit if no planet to spend it on. But as the title Global Warming clearly sets out, it's global. It's not a national issue, it's an issue collectively across the globe. And in this context, I give more than a nod towards our involvement with the whole Basel process, and indeed the letter from Mr. Sam Woods on this issue. I support the amendments down in the name of my noble friend, the Minister. I think they strike the right balance, and the need for a sense of transition, not in any sense slow or fast, but transition to get to where we need to get to across financial services and the wider economy. As earlier noble lords have commented, there's no benefit, quite the opposite, in taking an approach to a particular industry in a particular region of the United Kingdom only to have a more catastrophic climate impact by having to shore up resource from other parts of the globe. So, in short, the PRA has a role to play, as do all elements within the financial services sector. There's probably more that can be done in terms of the use of new technologies and the measurement of how funds and various assets are performing in this sense, and that is certainly within our grasp. It's not a matter for this group, but it could well provide a lot of the solution, certainly the clarity, and then the accountability which would come through that in the course of business. I fundamentally agree with my noble friend Baroness Noakes in her commentary on how large corporates go about their funding and
appear to have lost contact with Lord Holmes. I think perhaps we should move on to the next contributor, Baroness Altman.
My Lords, I have added my name to Amendment 3 in this group, moved so excellently by the noble Lord Oates, and I would like to congratulate him on his work on the issues relative to this group of amendments. May I also commend my noble friend, the noble Earl the Minister, and his department for listening to the concerns expressed at committee stage and for laying his own amendments to this bill, which previously made no mention of climate change at all. And I do believe that this government is committed to making a real difference on climate change and environmental issues, and has recognised the dangers our precious planet faces due to climate change and indeed biodiversity risks, as mentioned by the noble lady Baroness Bennett and in her amendment. So I welcome the government's amendments 43, 46, 47 and 49 and do hope that the issue of climate risk will continue to move up the agenda in terms of financial services. I have enormous respect for my noble friend Lady Noakes and of course her experience in banking. And she makes relevant distinctions between assets held by insurance companies regulated by the FCA, which hold investments directly in fossil fuel or environmentally damaging firms and activities, whereas the bank's main assets are loans rather than more direct investments. Their balance sheets, as she noted, do have some leasing, but also, should the worst predictions of climate catastrophe materialise in a shorter time frame than currently anticipated, then there could be unexpected defaults on a number of the loans on the loan books, which also need to be considered, I would hope, in terms of risk weightings. At committee stage, I supported the noble Lord Oates in seeking to update the existing capital risk weightings to reflect climate change risk. And having listened carefully to the committee's arguments, he has taken care to adjust his amendment for report stage. My Lords, climate change, as we have all discussed in this group, is recognised widely now as posing a significant risk to the entire global financial system, and in fact, to our expected and hoped for way of life. Current central bank policy currently risks reinforcing a carbon lock-in through a systemic bias to fossil fuel investments. And indeed, insurance arrangements and pension funds also have significant investments in this area. So I believe we need a twin-track approach which both reports on and quantifies climate-related financial risks, and at the same time amends prudential risk tools to reflect the risk of loss or stranding in relation to fossil fuel investments or indeed loan books. Such an approach would reflect the urgency of the challenge that we face. And as Andrew Bailey said in a speech last year, investments that look safe on a backward look may be existentially risky given climate risks. My noble friend the Minister's response committee stage was that the proposed amendments would require the PRA to set punitively high risk weights against exposure to existing and fossil fuel production and exploitation, and that these risk weights would in effect make it more expensive to finance such activities and thereby make them less attractive. Loans would be more expensive potentially to companies involved in this area. My lords, is this not the very point we should be seeking to achieve? To reflect the risks of carbon-intensive investments quantitatively through higher risk weightings and potentially through the issue of loans to such companies. Amendment 3 recognises the government's concerns and now proposes only that the PRA carry out a review of the current risk weightings applied to existing and new fossil fuel activities. And in this regard, such a review may indeed confirm what my noble friend Lady Oakes has suggested would be the outcome. But without such a review, my lords, I feel that we will not necessarily be taking this sufficiently seriously. And I hope my noble friend can agree that this is a reasonable and prudent way to recognise the urgency of the climate change challenges we face, and that it would provide evidence to inform any necessary future changes to existing prudential rules around capital weightings, should that be found to be required. In addition, we have had 2 reports just published highlighting the systemic nature of climate risks. The London School of Economics Grantham Institute report, and I declare an interest as a visiting professor, Net Zero Central Banking report stated that central banks and supervisors will need to take a systemic perspective, addressing both micro and macro prudential risks over a much longer time horizon than they do now, and work to ensure that financial flows become aligned with net zero. Policy Exchange's Capital Shift report recently stated, whereas international banking codes require banks to include emerging risks such as cybersecurity in capital adequacy compliance, climate change barely features, and it recommended that central banks and supervisors should introduce higher capital charges for assets at greater risk from climate and nature-related financial risk. I do hope that my noble friend the Minister might be able to provide assurances that an urgent review of this vitally important area is possible and will be considered. My Lords, may I speak briefly in support of the aims of Amendment 22 in the name of Baroness Hayman on climate-related financial risk reporting. And again, I commend her for the work that she has been doing in this area and declare a further interest as a member of the Peers for the Planet group, which she so ably leads. This would require adjustments to to reflect the systemic risk in the whole financial system. And I do hope that my noble friend might be able to commit to a future consultation, at least, on the FCA and PRA objectives to have regard to net zero targets. Finally, my lords, I have added my name to Amendment 23, also in the name of the noble lady Baroness Hayman, whose work on environmental protection has been so powerful. I would like to congratulate the new Chief Executive of the FCA, Nikhil Rathi, for the latest announcement that he is recruiting a senior role focused specifically on environmental and other ESG matters. And therefore, I suspect, my noble lords, that this amendment may no longer be required.
My lords, we've not as yet been able to restore contact with Lord Holmes of Richmond. Should he reappear before the Minister speaks, I will try to call him, but for the time being he's not with us. So I call Baroness Kramer.
My Lords, I will follow my practice of trying to be brief and selective at report stage. We have had absolutely brilliant speeches, and I don't intend to repeat them. But perhaps I could start by being helpful to Baroness Noakes. And I speak as a sort of, fairly weather-worn commercial banker who dealt extensively with loans and risk. So she will understand, therefore, that the PRA, as the regulator, in dealing with capital adequacy issues, looks at, indeed, the loans that sit as assets on the bank's books. But, of course, it doesn't stop there. It looks through that to the operational activities, to the activities and the investments of the company to whom the loan is made. And that is why the terminology investment pins exactly what this amendment is intended to do, which is to make sure that the PRA does that look-through to investment. And I don't think that any member of the PRA would have the slightest difficulty in understanding what this amendment was guiding them to carry out. They would see, indeed, that it had genuine precision in it. So I don't have a problem with the wording. The wording says what it should, and it says what it means, and it says what the PRA would understand and follow through. Now, just very briefly, I did want to say thank you to the Minister for the two have regard amendments that he has embedded in this grouping of amendments. The have regards to the climate change targets of 2050. It's a step forward, but I do think we have to recognise that it is very light touch. This is not one that is going to scare the horses, and I think Baroness Noakes captured that rather well when she said the two have regards will do no harm. I don't think they change the landscape. They give a little hint of a change in direction, and I welcome that change in direction. And like others, I'm very frustrated that we've got a PRA that is going to do stress tests to test the sufficiency of banks' capital buffers to deal with the financial instability caused by climate change, but then seems to have taken almost the equivalent of a vow of passivity that it won't then follow through and implement the consequential adjustments to capital adequacy ratios that would come from that exploration and examination of the buffers. I really don't understand going through the process and then saying, but one will not learn from and one will not implement the consequences of that work. The one thing I did want to tackle in just quite quickly, though, is I think sometimes as I listen to the speeches, there is a sense that this requirement to look at capital adequacy ratios that is sort of somehow novel or revolutionary. I sit on the Economic Affairs Committee, and last week we were privileged to hear from Lord Turner of Eschenswell. I hope I pronounced that correctly. We were looking at quantitative easing issues, and therefore it was a discussion of central banks, but the issue of climate change came up. And I thought what he said is quite helpful to understanding how normalised the approach of challenging this issue through capital adequacy ratios is now becoming. He was looking at the role of central banks and saying that any role of central banks in relation to climate change is very secondary to the fiscal and regulatory authorities. Now, that was the same issue that I think was raised in reference to quotes from Lord King. But that is an important statement, secondary to the fiscal and regulatory authorities, because, of course, the relevant regulatory authority is the PRA. And he went on to give an illustration by referring to coal. If banks go on lending to coal companies, they may end up with stranded assets in which they will make a loss. That is bad for their capital ratios. I think it is reasonable for the PRA to set higher capital ratios for anybody who is still lending to coal. Now, I don't want to suggest that he was willing to go further than coal, but he was using it in illustration. And I think most of this House would very happily accept that that language needs to be extended across the full range of fossil fuels, certainly in requiring the PRA to do a review. So I did want to underscore that this is a normalised approach, that this is where we will go and this is where we will end up. And given that we have described climate change absolutely correctly as an emergency, a delay in getting to that appropriate application of capital adequacy is really serious. And I wanted to pick up the point that Baroness Noakes made on the fact that most loans are short or medium term. They are short or medium term, but they're supporting longer term projects. Financing the project, the duration of financing the project itself, the project they enable, the project they empower, the project they drive, of course, has a much longer-term application. So the fact that the loan itself is short-term doesn't mean that it could be set aside as though it had no longer-term implications. It is merely the first step in an ongoing process, and once the process is started, it is almost impossible to stop. Loans might be short-term because people in the future think they might get better terms and conditions or pricing. So the short-term issue is not applicable here. The urgency issue is. We know that we face an emergency, and we know that how we act in the future will have to be more draconian, more dramatic, that have far greater collateral damage than if we act early. And so it really is crucial that the issues that are raised under Amendment 3 on getting in place the plan and the pattern and process for using capital adequacy ratios to tackle the financial instability that will come from allowing climate change activities to continue and grow needs to be done now, and it needs to be done rapidly. And so I hope very much that if the government doesn't pick up and recognise what we've been describing here, and commit to this review around the whole issue of capital adequacy and climate change, I hope very much that my colleague Lord Oates will choose to move his amendment. The message is absolutely critical.
I call the next speaker Baroness Jones of Whitchurch.
My Lords, I'm grateful to Lord Oates for leading this debate this afternoon and to all noble lords that have spoken. We had a detailed debate at committee on the need for regulators to take a more systematic and urgent approach to their climate change obligations, and I don't intend to repeat those general arguments, not least because the Minister, in his response, accepted the need to embed our climate change goals in the financial services sector. The point of difference remained how deep and how fast. Since that time, we've had a useful meeting with the Minister, and we were pleased to hear that he had accepted our arguments concerning the need for regulators to have regard to the Climate Change Act. The government's amendments tabled today reflect that concession, and we consider this to be a considerable step forward. I thank him for his work in making that happen. Since then, the Minister has also facilitated the sending of 2 letters from the ERA and the FCA setting out their work on sustainable finance, and a number of noble lords have referred to these letters. And it is useful to have their current commitments restated in this way, and we are pleased that they've engaged with us on the subject. And it's also helpful that they've set their work in an international context, as we know that this is an issue that we can't solve alone. However, I would say to the regulators, and indeed to the Treasury, that what is lacking from these letters is the urgency and the reprioritisation that climate change emergency demands. As we discussed at committee, there are many individual financial institutions which are already ahead of the game, and they are implementing dynamic green initiatives. And we heard great speeches from the Chancellor and others on the importance of the issue. But why aren't the regulators being more ambitious to ensure that everybody meets the standard of the best? As a result, my lords, today we have tabled further amendments to spell out in more detail how systematic financial-related climate risks should be embedded in the policy agenda going forward. Firstly, I've added my name to Amendment 3 in the name of Lord Oates. This addresses the need for the PRA to review their risk weighting applied to investments in existing and new fossil fuel exploitation and production. And the Noble Lord has explained the case on that amendment extremely well today. And we agree that the current regime doesn't adequately reflect the high risk exposure of such investments. Clearly, institutions with overexposure to carbon-intensive investments are not acting prudentially, and their capital requirements should reflect this. As we discussed before, as the policy agenda moves rapidly away from fossil fuels and towards renewables, there is a considerable risk of these assets being stranded. The capital adequacy requirements need to reflect this risk more accurately. With this in mind, the Minister will know that the Basel Committee conducted a survey of regulators in April last year to take a stocktake of their supervisory initiatives on climate change financial risk. This seems to run counter to the point, indeed, that Baroness Noakes was making, and I listened carefully to what she was saying about the comparative responsibilities of regulators and banks, because the Bank of England and the PRA were both respondents to the survey. And in fact, only 6 out of the 27 replies had factored in the mitigation of climate-related risk into their prudential capital requirements so far, but there was some criticism in the conclusions of the survey as a result of that. So can I ask the Minister whether the UK regulators were indeed in the good minority or in the bad majority in this regard in the outcome of that survey, and whether their responses to the survey are in the public domain? And does he also accept that without the adjustments that are needed in Amendment 3, investments will continue to focus disproportionately on outdated oil and gas activities that run counter not only to investments but to the interests of the UK economy as a whole? And this is a point I thought well illustrated by Baroness Sheehan. This is why we particularly welcome the involvement of the Climate Change Committee to provide a wider perspective of the longer-term UK interests rather than the narrow short-term interests on which investment decisions are all too often made. I therefore hope the Minister will be able to give us the assurances we seek in this regard. My Lords, I have also added my name to Amendment 22 in the name of Baroness Hayman, and again she made a very powerful case for this in the debate today. We believe it's essential that the government set out for the future how it will actively ensure that climate change considerations are reflected in the regulator's statutory objectives. This amendment would provide a framework for assessing and reporting on climate change financial risk in a systematic way. It would ensure that all the government guidance was linked up to provide a coherent whole picture on managing climate change, which would be much improved on the piecemeal reporting structure that we have at present. I therefore hope the Minister will be able to give us the assurances we seek on this issue. And it would also be helpful if he could spell out what future formal reporting mechanisms would be set in place to achieve this. My Lords, moving on to Amendment 23, Baroness Hayman at committee and again today has made a compelling case that the FCA need a senior executive to oversee and deliver the climate change agenda. So, like her, we were pleased to see in the FCA's letter that a dedicated director of environmental, social and governance standards was being recruited to lead on this work. We welcome this appointment and we believe this represents a real step forward. My Lords, on Amendment 44, Baroness Bennett has once again made the important point about action on climate change and biodiversity needing to go hand in hand. As my noble friend Lord Judd said, we are all too easily join UN international conventions on issues such as this, but we lack the discipline at a UK level to follow it through. And it does often feel that biodiversity is the poor relation of climate change. But we know that urgent action on both issues is essential if we are to have a thriving, sustainable planet in the longer term. And I agree with Baroness McIntosh that we should be aspiring to a future where all natural capital is valued in its proper place. And this is an issue that we will continue to pursue. Finally, my Lords, returning briefly to the Government's Amendments 43, 47 and 49, we very much welcome their inclusion in this bill today. Whilst it's the right thing to do, I don't doubt that the Minister had some persuading to do with his Treasury colleagues, and we thank him for that. These amendments represent another step in creating a cross-departmental approach to tackling climate change and, in due course, to meeting our net zero targets. So I look forward to the Minister's response to our amendments today and to hearing the specific reassurances we seek in order to more fully move forward with a credible package of actions to deliver our climate change obligations. So I look forward to the Minister's response.
I understand we now have Lord Holmes of Richmond back to finish his speech, so if I may call him at this point, Lord Holmes of Richmond.
My Lords, I shan't detain the House at this stage. I fear I got cut off just as I was extolling the virtues of how new technologies could help in this endeavour. All I'll say is I support the amendments in the name of my noble friend, the Minister, and look forward to his explanation of them. Thank you.
I'll now call Minister Earl Howe to respond.
My Lords, let me begin by saying I've listened carefully to the debate today, as well as the important contributions made in earlier debates on this bill. As a result of those earlier debates and subsequent discussions held with a number of your lordships, the government have tabled the 4 amendments included in this group, which I shall speak to in a moment. Before I do that, I want to leave the House in no doubt as to the context in which we are now operating. In November, my right honourable friend, the Chancellor, set out a vision for the financial services sector to put the full weight of private sector innovation, expertise and capital behind the critical global effort to tackle climate change and protect the environment. And that is why the government is taking a number of actions, such as making climate-related financial disclosures mandatory across the economy by 2025, with a significant portion of mandatory requirements in place by 2023, and issuing our first ever green gilt later this year. And at budget this month, we augmented the government's economic objectives and the remit of the Monetary Policy Committee and Financial Policy Committee to support environmental sustainability and the transition to net zero. We established the UK Infrastructure Bank with a mandate that includes tackling climate change. And so, my Lords, the government has ambitious plans to ensure that the financial services sector as a whole plays its role in supporting our climate change commitments. But we heard loud and clear the strong views from members of this House that they wanted to see that ambition reflected in this bill. Amendments 43 and 47 in my name will require the PRA and the FCA to consider the 2050 carbon target in relation to the Climate Change Act 2008 when making prudential rules under the accountability framework set out in this bill. This is the government showing very publicly how the financial services sector and our regulators can take a lead role in delivering on our climate commitments and showing the rest of the world that the UK is taking a cross-sector approach. I've greatly welcomed the way noble lords have engaged with me on this issue. We've picked the 2050 carbon target as it benefits from being both legally defined and focused in its substance. This makes it clear to both regulators exactly what they must have regard to in making their rules, and makes it clear too how they can be held to account. My Lords, as I've explained in earlier debates, the government and the regulators are committed to implementing the first wave of Basel reforms and the initial introduction of the investment firm's prudential regime for the 1st of January 2022. These reforms are important for our international standing as a country that upholds its international commitments. They're important for financial stability, and they are important for our competitiveness relative to the EU. And as I said during the committee debates, there's a great deal of work happening at the moment at the international standard setting level to determine exactly how climate change should be factored into prudential policy globally. And that is why Amendments 46 and 49 delay the application of mandatory climate change considerations to the 1st of January 2022. This will ensure there is sufficient time for this work to progress and that there's no unnecessary and impractical delay in implementing these vital regimes. Otherwise, we would be in the unfortunate position where the regulators would have to reopen or restart their consultations. So, when and how will the amendments bite, if not on the first wave of Basel and the IFPR? I can assure noble lords, and the noble Baroness Lady Hayman in particular, that the PRA will still need to make rules to implement substantive reforms contained in Basel 3.1, which will be implemented in 2023. Those rules will be within the scope of the amendments in my name. And I fully expect the regulators to use the powers again in future to update their rules, for example, to take account of new international standards or developments in the market. So I hope the House will agree that these amendments strike the right balance between taking action on climate change quickly and swift action to reform our prudential regimes, which aims to prevent a future crisis. I do therefore see this as a significant action that demonstrates very visibly the government's commitment to furthering this important agenda. My Lords, the government is also acting to ensure that the regulators take account of our climate commitments more broadly. At Budget, the Treasury published remit letters for the Monetary Policy Committee and the Financial Policy Committee, requiring both these committees to consider the government's commitments on climate change. And just today, I can confirm that the Chancellor has set new remits for the FCA and the PRA, which will require them to consider these commitments as well across the whole of their remit. As has been mentioned in this debate, the CEO of the PRA and the CEO of the FCA have both written to me to set out the significant amount of work they have underway, which I will provide some further details on in a moment, and to demonstrate their clear commitment to acting to address climate change. I placed copies of their letters in the library and in the Royal Gallery. Finally, and importantly, there is the Future Regulatory Framework Review. That is the means by which the government is exploring how the regulators focus on important public policy issues, such as climate, more broadly. I hope that point meets one of the concerns expressed by the noble Baroness Lady Hayman. And I can add to it because as part of that review, the government recently consulted on a proposal to allow Parliament and ministers to specify new regulatory principles for specific areas of activity. For example, setting out how the regulators must consider sustainability or green issues when making rules. The government is considering the responses to the consultation ahead of a second consultation later this year and recognises the need to address this crucial issue across the whole regulatory framework. So, my Lords, I hope I've shown that the government understands the issue, that it is taking the appropriate actions, and that the regulators are ready and willing to support such actions. I will now turn to the other amendments in this group, though not in numerical order. I'll begin with Amendment 44, which would amend one of my own amendments. This amendment would require the FCA to also take into consideration the UK's commitments under the UN Convention on Biodiversity when making rules to implement the investment firm's prudential regime. My Lords, this government is committed to being the first to leave the natural environment in a better state than it found it, with our long-term agenda laid out in the 25-year Environment Plan. As the Dasgupta review highlights, and as the noble Baroness recognises, the global financial system will play a critical role in enhancing our stock of natural assets and encourage sustainable consumption and production activities. We will reflect on the conclusions and recommendations of the Dasgupta review and consider the most appropriate way to take them forward. However, unlike the 2050 carbon target and the Climate Change Act 2008, which my own amendment targets, the commitments under the UN Convention are extensive and varied and more challenging to deliver through financial services regulation. Work on how the financial sector can support our transition towards net zero is more developed than work on how the sector can support biodiversity goals. However, work to develop our understanding is underway. For example, just last year we saw the launch of the Task Force for Nature-Related Financial Disclosures. This task force will provide a framework for businesses to assess, manage and report on their dependencies and impacts on nature. This will support the appraisal of nature-related risk and will continue to realign incentives which support our biodiversity goals. The Convention on Biological Diversity, COP15, will also be an important milestone for international action on biodiversity. We will work with countries to agree long-term, realistic, measurable and fit-for-purpose targets to set nature on the path to recovery. Nature will also feature as one of 5 policy themes for COP26, which has been agreed by the Prime Minister. The Nature campaign is focused on catalysing action to protect and restore the natural habitats and ecosystems on which our climate, air, water and way of life depend, which includes increasing the volume of finance for nature-based solutions. And I listened with particular interest to the remarks of the Noble Lord Judd in that particular context. Turning to Amendment 3, this would place a legal obligation on the PRA to review the risk weights applied to certain fossil fuel exposures and thereby the amount of capital held against them. The purpose of risk weighting is to preserve the safety and soundness of our financial system and to prevent banks from failing as a result of not covering themselves appropriately against the risks that they are taking. And I was grateful for the remarks of my noble friend Lady Noakes on these issues. In its letter to me, the PRA recognises the threat posed by climate change to the UK economy and the financial system and sets out the steps it's taking to mitigate this threat. This includes setting out specific and detailed supervisory expectations for both banks and insurers on their approach to managing financial risks from climate change. The PRA has also written to firms setting out their expectations that firms should have fully embedded their approaches to managing climate-related financial risks by the end of 2021. The Noble Lord Oates questioned why there should be a lower risk rating applied to fossil fuel funding than some other asset classes. As I'm sure he is aware, the risk weighting of assets is something that is decided internationally through a set of agreed standards set by the Basel Committee on Banking Supervision. And this is based on analysis of how risk is transmitted and how it can be quantified. These post-crisis reforms have also been endorsed by the G20 and ensures risk weights are applied consistently across the globe. The flexible approach taken in the bill ensures that where considerations around the risk weighting of assets changes, the PRA can respond to developing circumstances as they arise. My Lords, we must not act with undue haste, but rather with appropriate speed. In 2020, the Network for Greening the Financial System, which was a group of central banks and supervisors, found insufficient evidence at that time of a measurable difference in the risk posed by brown and green asset classes. And so further work is needed. The Basel Committee Task Force on Climate-Related Financial Risks is seeking to understand how climate risk is transmitted, measured and assessed. This task force plans to complete this fundamental research by the middle of this year. Building on this analytical work, and to address a question asked by the Noble Baroness Lady Hayman, the task force will consider the extent to which climate-related financial risks are incorporated into the existing Basel framework and identify effective supervisory practices to mitigate such risks. So, the review that Noble Lords wish to see is already underway, and we will see more on this in the autumn. And I hope the Noble Lord Oates will agree that this review demonstrates that the Basel Committee, which the PRA is a member of, is already considering climate risks in the financial system, and that this will persuade him not to move his amendment. My Lords, in this context, perhaps I could quickly respond to the Noble Baroness Lady Sheehan, who made a number of points relating to the funding of overseas projects by UK Export Finance. I'd be happy to write to her on this further to our previous correspondence on the subject. Amendment 22 is broader, as it would require the regulators to regularly review the exposure to climate-related financial risks and the impact on financial stability. The PRA's existing obligations under the Financial Services and Markets Act already require them to consider risks to the safety and soundness of financial institutions, and this includes climate risks in the same way as any other risks. And the PRA will be undertaking further climate-related stress tests in June to ensure the financial system remains resilient to climate-related risks. I shall answer as best I can the Noble Baroness Lady Kramer's question on those stress tests, which I have not got up-to-date details of, I'm sorry. Our green finance strategy commits the government to improving the understanding throughout the financial system about climate risk and environmental impact. I've already said that the government has committed to implementing the requirements of the Task Force on Climate-Related Financial Disclosures in the UK, with a significant portion of mandatory requirements in place by 2023, and all relevant firms reporting in line with the requirements by 2025. And this requires firms to investigate, report and manage the climate risks that they face. The UK is the first country to take such a step, and we are a long way ahead, incidentally, of the EU in doing so. And the Bank of England reported publicly on its own climate risk exposure in June 2020. I do think that the government's approach in this area can be seen as systemic, to pick up the word used by the Noble Baroness Lady Hayman. Amendment 22 would also require Her Majesty's Treasury to review how the FCA and PRA's objectives have regard to the Climate Change Act 2008. My own amendments ensure that the regulators will consider this when implementing their prudential regimes, and the remit letters set by the Chancellor also require this. I now turn to Amendment 23, which aims to require the FCA to appoint a senior manager with responsibility for climate change. And I'm happy to confirm that in his letter to me, the CEO of the FCA has committed to recruiting a dedicated director of environment, social and governance standards. And this director will report directly to the CEO of the FCA and will have responsibility for the FCA's ambitious work programme in this area. So I'm happy to confirm that it isn't necessary to set out this requirement in legislation. My Lords, I hope that what I have said will have demonstrated that the government has not only listened to the arguments and, through the amendments in my name, responded tangibly to those arguments, but is also on substantively the same page as are those noble lords who rightly feel passionately about these issues. Therefore, against that background, I commend my own amendments to the House, and I would ask noble lords in turn to withdraw their own amendments.
Any requests to ask questions of the Minister, so I now call on Lord Oates.
My Lords, I thank all who've taken part in this interesting and engaging debate, and I give particular thanks to Baroness Hayman, Baroness Jones of Whitchurch and Baroness Altman for signing the amendment number 3, and to my noble friend Baroness Kramer, and also to the noble Lady Baroness Bennett. I'm also grateful to the Minister for his engagement at all times. I'm sorry if the wording of Amendment 3 caused any confusion to the noble Lady Baroness notes, but I hope that my noble friend Baroness Kramer's clear explanation has lifted that confusion. I don't think I have anything to add to that, except that I've no doubt that the PRA will understand very clearly what they're being asked to do. The noble Lord Viscount Trenchard said in the debate that he felt a review was disproportionate. I was not sure what he was measuring the proportions against, but if anything, the amendment seems to me a disproportionately modest response to a desperately urgent issue that will impact on all of us. I'm pleased that the Minister and the FCA have reacted to a number of the amendments, in particular Baroness Hayman's Amendment 23 on the FCA Senior Manager, and I welcome the movement, as I've said, obviously, on the Government's amendments on the have regard. I reiterate my thanks to the Noble Earl, the Minister, for his engagement during this whole process, although I'm disappointed he hasn't been able to provide the reassurance I had hoped for that risk weights would be properly addressed. He said we had to move not with undue haste, but with due speed. But, my Lords, I'm not sure we're doing either. And I'm afraid I don't accept that the issues are sufficiently covered by the existing work that he has taken the trouble to set out, not least because the approach that is being followed does not sufficiently take into account the specific issues set out for the review in my amendment, in particular the climate-related disruption of the economy. And I think it's very important this review can take place, the PRA can use it to look properly into these issues, and that it can obviously feed in, as I said in my opening speech, into the discussions at an international level. But it's very important that it is looked at in terms of the remit of the amendment that I have put down. So on that basis, my Lords, I would like to test the opinion of the House.
I shall now therefore put the question. The question is that this amendment be agreed to. As many as are of that opinion will say content. Contrary, not content. Content, have it. Not content, have it. The question will be decided by a remote division. I instruct the clerk to start a remote division. Open. Members are now invited to record their votes using the remote voting system. Members will have 10 minutes to record their votes, and I will make an announcement when the remote voting period has ended. Clear the bar. The remote voting period has now finished. The remote voting period has now finished. I will announce the result as soon as possible. I can now announce the result of the remote division. The question was that Amendment 3 be agreed to. They have voted content 276, not content 276. This is an equality of votes, so the not contents have it. We now come to the group beginning with Amendment 4. Anyone wishing to press this or anything else in this group to a division must make that clear in debate. After Clause 15, Amendment 4, Baroness Noakes.
My Lords, I shall move Amendment number 4 and also speak to the other two amendments in this group in my name. And I'm grateful to the Noble Baroness Lady Bowles of Berkhamsted and the Noble Lord Equil for adding their names to Amendment number 6. I spoke at length in committee about the problems of tough legacy contracts, and I will not repeat all of that. And to summarise, when LIBOR ceases to be available at the end of this year, there will be a number of contracts which reference LIBOR, but which have not been renegotiated to substitute an alternative rate. We do not know exactly how many contracts are involved, but it is thought to be a significant number. And it is not a niche problem. It arises in both commercial capital market and in retail markets, and in many different kinds of contract. While sustained efforts by financial services providers has reduced the scale of the problem, it cannot be fully resolved for various reasons, and I think that has been accepted by all parties. Now, the bill helpfully provides for the FCA to ensure that what is known as synthetic LIBOR will be available for use when those contracts which have not been renegotiated, use in those contracts which have not been renegotiated, but two problems remain. First, the fact that while the FCA has made synthetic LIBOR available for use, the FCA cannot change the contracts themselves. That requires separate provision in law, and Amendment 4 provides for continuity of contract so that any contract loan or security referencing LIBOR will be taken to reference synthetic LIBOR instead. Secondly, even if references to LIBOR are regarded as meaning synthetic LIBOR, there remains a risk of litigation if one or more parties object to the substitution of synthetic LIBOR and believes that some other fallback is more appropriate. Amendment 5 says that no claim or cause of action can arise due to the use of synthetic LIBOR. This is the safe harbour provision. Now, I recognise that the exact drafting of both continuity of contract and safe harbour is not straightforward, though I would emphasise that my amendments have been drafted with the help of lawyers who are specialists in capital markets, and they mirror the draft legislation which has been drawn up in New York law by ARC, the Alternative Reference Rate Committee. Nevertheless, I've also tabled Amendment 6, which takes a slightly different approach by giving the Treasury the power to make regulations to deal with both contract continuity and safe harbour, or either of those matters. It does not require the Treasury to do either or both of those things, but offers a straightforward method of dealing with the problem in secondary legislation if, for some reason, the government feel unable to legislate directly at this stage. I tabled Amendments 4 and 5 in committee and was met with the expected response that the government had recently issued a consultation on both contract continuity and safe harbour, and that the consultation period had not concluded. The government would decide what to do once they had considered the consultation responses. Well, the consultation has indeed now concluded, and so it is time for the government to decide what to do. As I understand it, there were only a relatively small number of responses to the consultation, and that they are overwhelmingly in favour of proceeding with both continuity of contract and safe harbour, and I hope that my noble friend the Minister will confirm that. I had hoped that the government would have tabled amendments of their own for this report stage, but life is full of disappointments. The clock is counting down to the 31st of December this year, and those areas of the financial services market which are impacted by tough legacy contracts desperately need some certainty about the way forward. I therefore call on the government to either accept one of my amendment variants, numbers 4 and 5, or alternatively Amendment 6, or commit to bringing their own amendment forward at third reading. If the opportunity of this bill is missed, it is by no means clear whether there will be a later opportunity in time for the cessation of LIBOR in only 9 months' time. I hope the government will want to avoid creating a long period of uncertainty and will not let this bill pass into law without fully dealing with tough legacy contracts. I beg to move.
Amendment proposed after Clause 15, insert the new clause as printed on the marshalled list. I now call Lord Trenchard.
My Lords, I apologise that I forgot to declare my interest as a director of 2 financial services regulated companies. I support Amendments 4, 5 and 6, ably moved by my noble friend Lady Noakes, whose long experience and mastery of the detail of financial markets and regulation is an invaluable asset to your Lordship's House. As far as Amendments 4 and 5 are concerned, she presented the arguments very well at committee stage and again today. I was also impressed by the arguments deployed by the noble Lord Eatwell, who quoted the FCA's view that in cases where parties to contracts referencing LIBOR cannot reach agreement on how those contracts would operate in the event of LIBOR's cessation, discontinuation could cause uncertainty, litigation, or loss of value because contracts no longer function as intended. My noble friend the Minister recognised that we need to reduce contracts that reference LIBOR as much as possible by the end of this year. However, given the vast number of outstanding contracts, that is clearly not going to be possible, and the government has rightly initiated a consultation process on this subject. However, does my noble friend not agree that the risk of uncertainty and litigation is significant, and that there is unlikely to be a better opportunity to legislate in time to mitigate such risks than this bill provides. My noble friend Lady Noakes has offered an alternative method of mitigating these risks in Amendment 6, also supported by the noble Baroness Lady Bowles of Berkhamsted and the noble Lord Eatwell. As a rule, I do not like the trend towards taking excessive Henry VIII powers, which greatly reduce transparency and accountability of the government. However, if my noble friend the Minister cannot accept Amendments 4 and 5, in this case I think this alternative amendment would be acceptable as being very much better than the situation which will otherwise quite possibly evolve with great damage to market integrity and much expensive litigation. I hope that my noble friend the Minister has thought more about these issues since our last debate, and look forward to hearing how her thinking has evolved to meet the very sensible points which my noble friend's amendments would address.
Baroness Bowles of Berkhamsted.
My Lords, at committee I supported the amendments of the noble Lady Baroness Noakes as something that had to be done, and it seemed a reasonable, if simple, concept that a flawed benchmark reference in a contract, if changed to the closely corresponding but not flawed benchmark, a change required by the regulator, then should that happen, and it should not give rise to litigation, not least as the contracts should still largely perform as originally intended. Some of them may have had termination clauses for the event of no benchmark, and that could give rise to premature terminations and winner and loser effects. But really, this is not a no benchmark situation. And while not everybody has sympathy with banks and industry, should they be the losers, this is not really a matter at which they are at fault. I'm sure everyone would have sympathy if consumers are losers, but what if it goes the other way and banks want to pursue consumers if consumers are the winner? I'm sure that would be seen as unacceptable. This is not mis-selling. It is, as far as contracts are concerned, a blameless matter, and seems to me that continuity is the closest to honouring original intents. If there were a way to make simple compensatory adjustments, then I don't think that we would be facing these problems. So I do still feel that something has to be done, and doing the same as the US also seems good in terms of the UK's reputation for giving certainty to markets. However, now Lady Noakes has also come up with a third new Amendment 6 that empowers the Treasury to address matters further down the track and gives more flexibility, perhaps, in what may be determined. On the one hand, it is a bit of kicking the can down the road and also a bit of Henry VIII, but one hopes that it will encourage more solutions to be found. And so I have added my name to that third amendment, and I hope that at least if the Minister cannot accept other amendments, that this could be accepted as a way forward.
Holmes of Richmond.
My Lords, I'm delighted to speak to this group of amendments and declare my interests as in the register. Can I congratulate my noble friend Baroness Noakes, not just for the eloquence she demonstrated in introducing these three amendments, but also in the quality of the drafting of 4, 5 and 6. As an ex-city solicitor, I look on with awe at the quality of the drafting work. Can I also congratulate my noble friend on offering options? We had a very thorough and in-depth debate in committee on these issues, Lady Noakes has done the House a great service in bringing a buffet approach for the government. If the government aren't partial to 4 and 5, 6 will work just as satisfactorily. My Lords, these amendments need to be seriously considered for the want of certainty and for ensuring a lack of litigation resulting if we do nothing. Can I ask my noble friend, the Minister, as I have done in the past and will do with upcoming amendments, for 4, 5 or 6, if not this financial services bill, which financial services bill? If not now, when?
Call Lord Blackwell.
My Lords, I declare my interest, as said at the Register. I'd like briefly to support these amendments, which have been so well explained by my noble friend Baroness Noakes. In Grand Committee, the Minister accepted that there were concerns that there was a residual risk of disruption and potential litigation that would remain even once the FCA had exercised its powers under the bill. This is really important, given the amount of money at stake, the number of contracts at stake, and the timescale of the changes in the benchmark at the end of 2021. My noble friend, the Minister, said that the government would prefer to wait for the results of the consultation. But these are not new issues. These have been issues that people have been aware of, the Treasury has been aware of, regulators have been aware of for many months. And the argument was made that the reason for waiting for the consultation is that there might be areas where there was legitimate reason for civil litigation, and that the litigation might block those legitimate legal claims. Well, my Lords, I really can't think of situations where I'm not persuaded, anyway, that there are situations where there are legitimate legal claims where the benchmark is being replaced by a synthetic benchmark at the direction of the regulator. There has to be a change, and it doesn't seem to me that I can think of situations where those claims might be appropriate and fair. But I'd welcome if the Minister can explain where those concerns come from, what situations might be blocked unfairly by these amendments. Other than that, it seems to me that we should move now to deal with these concerns. As noble Lords have said, if the Minister doesn't like the specificity of amendments 4 and 5, I certainly would be prepared to accept Amendment 6. And I hope that my noble friend will come back at second reading, at third reading, with amendments from the government to address these issues. If my noble friend, the Minister, doesn't feel able to do that, and if my noble friend Baroness Noakes were to bring back her amendments at third reading, then I feel I would be compelled to support her in that. Thank you.
Now call Baroness Kramer.
Lords, I'm grateful to Baroness Noakes for bringing forward these amendments. I have to confess I'm not keen on Amendment 5 because it seems to me that it does create an opportunity for various institutions to use the change in the benchmark in a way that would be abusive to a customer, and that customer would then have no redress. So 5, I think, just goes too far. But Amendment 6, to me, makes perfect sense, and I find it absolutely extraordinary to think that the government hasn't, quite frankly, just seized it and put a G in front of it. because we will face tough legacy contracts. There does need to be a sensible and appropriate way to deal with them, and it seems to me that Amendment 6 captures that exactly as it should. So I hope very much that Baroness Noakes will get a positive reply on 6 today from the government, because otherwise there's going to be litigation and a mess, and I'm not sure that that helps anybody.
I now call Lord Eatwell.
My Lords, I think we should all be grateful to the noble lady Baroness Noakes for her persistence in this vital area. And in particular, she's quite right that the clock is ticking. It's 9 months to go, and we really need to do something about this. Otherwise, it would be irresponsible on our behalf. Looking at the 3 amendments, Amendment 4 is valuable in defining continuity of contract, but there then remains the problem that it doesn't solve, which is, and cannot solve, which is that if the foundation of a contract is changed, its value can well change. And that leads on to Amendment 5. And here I regret I differ with the noble lady Baroness Noakes and with Baroness Bowles. It's surely the responsibility of Parliament primarily, in this case, to protect the retail investor, since it's the retail investor who is not the professional, who typically does not have the same information as the professional, and is likely to be more financially vulnerable, not least because retail investment is dominated by pension savings. I therefore conclude that the provision of a safe harbour is inappropriate in this case, and would be looking instead for some mechanism of reconciliation rather than prevention of claim. However, I'm delighted to express my support for Amendment 6. Not surprising, I suppose, because my name is on it, but anyhow, I'm delighted to support it because I think here Baroness Noakes has actually saved the government from considerable embarrassment by, at this time, presenting an amendment which encapsulates in a succinct manner, without being prescriptive, the issues that the FCA must address in facing the difficulties created by the replacement of LIBOR. And namely, those difficulties are the problem of the continuity of contract and the problem of reconciling the damages, 4 and 5, but 6 actually incorporates those. And so I would like to express strong support for Amendment 6, to recommend it most wholeheartedly to the government. In terms of the buffet approach, this is the healthy option.
My Lords, you will remember from previous stages that this bill provides the FCA with the powers to manage an orderly wind down of a critical benchmark, such as the LIBOR benchmark. In 2015, the Financial Stability Board recommended a transition away from certain interest rate benchmarks, including LIBOR, to alternative rates that are based on active and liquid underlying markets. And in 2017, the FCA secured agreement from the panel banks that contribute to LIBOR that they would continue submissions until the end of 2021, providing time for firms to move away from use of LIBOR wherever possible. However, it has been clear for some time that there will be certain tough legacy contracts that will not be able to transition away from LIBOR in time. It is for the benefit of these contracts that the bill grants the FCA the power under Article 23D of the benchmarks regulation to direct a change in how a benchmark is calculated, so that the benchmark can continue for a limited time after banks stop providing their contributions. This bill therefore represents a critical step in providing for a smooth transition away from LIBOR, mitigating the risk of financial instability and market disruption that could be caused by a disorderly transition or end to LIBOR, and has widely been welcomed by the financial services industry and internationally. These proposed amendments seek to supplement the bill provisions, reducing further the scope for uncertainty, contractual disputes or litigation between parties over the reference to a benchmark within a contract, where the FCA has directed a change in the methodology on which the benchmark is calculated. Amendment 4 seeks to provide for contract continuity where the FCA uses its Article 23D power to impose a change in the methodology of a critical benchmark, providing that parties must interpret references to that benchmark in their contracts as references to the revised benchmark. Amendment 5 seeks to reduce the scope for litigation where the FCA has exercised its Article 23D power on a critical benchmark, providing a safe harbour for the use of that benchmark. As stated at committee and in the other place, the government is committed to ensuring that there is an appropriate framework in place for the orderly wind down of LIBOR. We take this matter very seriously. As the noble Lady Baroness Noakes noted, the government's consultation on this issue has closed only recently on the 15th of March. The consultation responses have underscored that there are complex and wide-ranging policy and legal considerations that must be fully understood before taking any further action on this issue. And I think that range of considerations and views has been illustrated by the range of views on this issue expressed in this evening's debate. But the noble Baroness Lady Noakes is correct to say that industry, including through their responses to the consultation, has indicated that they are supportive of the approach set out by government in that consultation. Whilst I am sympathetic to the objective that these amendments seek to support an orderly wind down of the LIBOR benchmark, they do raise complex issues that our consultation was designed to explore further. For example, Amendment 5 would provide a wide legal protection to parties using the revised benchmark against all forms of claims or causes of legal action associated with the exercise of the FCA's power in Article 23D, subsection 2 of the regulation. I've not been convinced that such a wide-ranging legal protection is appropriate, and it could have serious and significant unintended consequences. It would also provide legal protections for such consequential changes that are, in the opinion of any party to such contract, security or instrument, reasonably necessary. I'm concerned that this does not remove the potential for dispute, but instead risks introducing an element of uncertainty as parties dispute what is or is not a reasonably necessary change. It is therefore at risk of causing the sorts of disputes surrounding the wind down of a benchmark which a safe harbour amendment seeks to avoid. I raise these points simply to illustrate the complexity of the issues, as I appreciate the noble Baroness is seeking to ensure that these issues have been fully thought through and addressed as appropriate. Turning to Amendment 6, my Lords, which may seem to solve those problems by seeking to give the Treasury powers to make regulations providing for contract continuity and safe harbour through secondary legislation, having had more time to consider these matters. The government is of the view that if legislation was needed to address this, it should be in the form of primary legislation. Further legislation providing for safe harbour, as proposed by these amendments, while consistent with the provisions already contained in this bill, may be considered by some parties to represent a significant intervention into the contractual rights of parties using critical benchmarks. Primary legislation would therefore be preferable to provide all parties with an appropriate level of transparency. And crucially, given the volume and value of contracts impacted, making such a provision in secondary legislation would carry a risk of legal challenge to the government's exercise of its powers. Any such challenge could bring further uncertainty and disruption, which is precisely what these amendments are seeking to mitigate against. I would, however, like to reiterate that the government takes the issues raised by the noble Baroness and others in this debate very seriously and will consider carefully the full range of issues raised through the consultation responses before deciding on an appropriate next step. I'm afraid to say to the noble Lord Blackwell and others that I don't think this will be in time for third reading, and nor can I point to the noble Lord Holmes to a subsequent specific bill in future at this stage. What I can say to noble lords is I know that the Economic Secretary to the Treasury is fully appraised of the need to quickly ensure clarity on this important issue. He has been leading on this matter for the government and has agreed to meet with the Noble Baroness and provide an update to the House as appropriate as soon as he is in a position to provide a substantive update on the outcome of the consultation. I therefore ask on that basis if the Noble Baroness will perhaps not be happy to withdraw her amendments, but nevertheless may consider doing so.
I've also received no request to speak after the Minister. Therefore, I call the Noble Lady Baroness Noakes to conclude the debate on her amendment.
My Lords, may I start by thanking all Noble Lords who have spoken in this short debate, and I even include my noble friend the Minister, though she will know that much of what she said was very disappointing, not only to the Noble Lords who have taken part in this debate, but also to the financial services industry, which was hoping for a more definitive outcome. I believe that letting the opportunity for legislating in this bill go by, even if only by way of a regulation-making power, is a major loss, and I'm struggling to understand how the Treasury could have got itself into this position. The need to deal with tough legacy contracts is most certainly not a new issue, and the fact that both contract continuity and safe harbour provisions were an issue for the financial services sector has been known for over a year. In the US, there is already draft legislation for New York law, and even the EU has brought forward a partial solution. But the Treasury seems like a rabbit staring into the headlights, too frightened to move. I have to say this does not augur well for the UK's ability to build and maintain our financial services sector as world-leading, which I'd thought was one of the aims of my right honourable friend, the Chancellor of the Exchequer. We cannot now blame the suffocating bureaucracy of the EU anymore if our financial services sector is held back or harmed. Taking back control requires that the government must take responsibility for their role in making the UK a good place for financial services firms, and their inability to deal with the issue of tough legacy LIBOR contracts in this bill is not a good look. I think that the government, in particular the Treasury, need to take a long, hard look at themselves and work out if they are yet up to the task of supporting this sector, which is so important to the UK as a whole. And their ability to act at pace and decisively is important, and I do not yet detect that they are showing those characteristics. Having said that, I was grateful that my noble friend the Minister did confirm that the government remained committed to a framework for an orderly transition from LIBOR next year, and that the government are taking this seriously and will find a way forward, but she did not indicate when what time frame that would be decided in. She ought to be aware that the financial service sector is watching and expect the government to take this forward. I'm grateful for the opportunity to discuss progress with the Economic Secretary in due course, but I think discussion with me is not the most important thing. I think it is telling Parliament what is to be done and when it's to be done and how it's to be done, and telling the financial services sector, which needs certainty for the way forward. It's with considerable regret that I beg leave to withdraw my amendment.
Is it your Lordship's pleasure this amendment be withdrawn? Amendment by leave withdrawn. My Lords, we move to the group consisting of
we have amendments 5 and 6, which we to be put and we think not moved.
Yes, I needed the correction. I'm so sorry. Amendments 5 and 6 not moved, and so we now move, after my error, to the group consisting of Amendment 7. Anyone wishing to press this amendment to a division must make that clear in debate. Clause 22, Amendment 7. My Lords, the Lord Bishop of St Albans has withdrawn, and I call on Lord Seeker, who has added his name to the amendment, to move it. Lord Seeker.
Thank you. My Lords, the Right Reverend Prelate, the Bishop of St Albans, sends his apologies as due to unforeseen circumstances, he's unable to speak to Amendment 7 and at very short notice has asked me to speak for him. Amendment 7, in the name of the Bishop of St Albans, myself and Noble Baroness Bennett of Manor Castle, requires companies operating under the Gibraltar Authorization Regime, or GAR, to be registered and to file their accounts in the UK at Companies House. It also ensures that GAR companies are regulated in respect of their UK activities in accordance with UK regulations. My Lords, my Lords, I beg your indulgence, and in order to minimise disservice to the Bishop of St Albans, I will speak in two parts. Firstly, relay what the Bishop himself would have said, and secondly, briefly to add my own comments. In the words of the Bishop of St Albans, I have placed this amendment because I did not feel that my concerns surrounding Gibraltar were adequately satisfied at committee stage when I tabled a similar amendment. I will be frank in that I got the impression that because Gibraltar was an associated territory, there was a reluctance to ensure that it cannot be used by companies to reduce their tax obligations. I do understand that the Gibraltar authorization regime allows for the continuity of financial services that existed when we were a member of the EU. But this should not discount the fact that what is being created here is a single market in financial services. Gibraltar is not necessarily a serial global tax haven. In fact, according to the Tax Justice Network, Gibraltar ranked 30th in the Corporate Tax Haven Index, whereas the UK is ranked at number 13. So I do not want this in any way to be an attack on the territory of Gibraltar, particularly when highlighting an issue that the UK itself is ranked as a worst tax haven. However, there is a specific UK-Gibraltar issue relating to tax avoidance, which this amendment attempts to speak to. The current relationship allows a Gibraltar-based company to operate in the UK, to conduct their business in the UK, and receive what would be taxable income in the UK, but then pay corporation tax in Gibraltar. There is a corporation tax disparity between the UK and Gibraltar. Our corporation tax is 19%, whereas Gibraltar is 10%. During his evidence session, the minister from Gibraltar said that corporation tax rate was not a factor in companies relocating to Gibraltar. And no doubt, the Mediterranean climate and lifestyle make it very attractive place to reside. But I would not presume that it is the warm climate that is responsible for 20% of UK's private insurance market being underwritten from Gibraltar, despite the territory not even holding 0.1% of the UK's population. Financial services are one of the Gibraltar's primary industries, hence why this amendment has been placed. Ideally, through stricter and more thorough reporting standards between Gibraltar and the UK, one would assume that greater transparency would apply to the finance and other sectors. It is common practice among many industries for transactions placed in the UK to be processed via servers in Gibraltar, a technicality that allows what in reality is taxable income in the UK to be taxed in Gibraltar. Getting evidence on the cost of the system to the UK Treasury is difficult. However, one sector we do have reliable data for is the online gaming and gambling sector. Research and private investigations have shown that some of the UK's major gambling firms paid an actual corporation tax in the UK of between 3 and 13%, by either headquartering or using subsidiaries based in Gibraltar. We only know of this because the size of these firms brought them under journalistic scrutiny. If these practices were well documented amongst one sector, it would be illogical if other sectors did not follow the same incentives. After all, the purpose of reducing corporation tax is only one major reason for relocation to Gibraltar. This amendment does not deal with the issue of taxation. In fact, even if the government adopted the amendment, these practices would still continue. What it would do is to ensure that companies operating under the GAR regime abide by the Companies Act 2006, which mandates foreign companies to register and file accounts at Companies House. I believe that the continuation of access to the UK financial market by permitted Gibraltar-based persons ought to be contingent on effective information exchange and reporting transparency requirements between the two jurisdictions. I think the Treasury and the UK public would be interested in knowing the extent of financial business conducted in the UK by firms based in Gibraltar, and the potential loss of corporation tax brought about by this arrangement. Certainly, the GAR is a rather one-sided agreement, giving Gibraltar-based companies access to 65 million potential customers, whereas in return the UK only gains access to 30,000 potential Gibraltar customers. Leaning on the emotional, cultural and historic reasons for this agreement should not hide the fact that the agreement is of great financial benefit to Gibraltar as a territory, whereas it is not clear how this benefits ordinary UK citizens. Since it is plausible that this arrangement may be a financial loss to the UK in terms of corporation tax, I think UK citizens and Her Majesty's Treasury, as a minimum, deserve transparency, and with that equal reporting requirement between UK companies operating in the UK and those operating under GAR. That concludes the statement from the Bishop. If I may just add a few words of my own, please. My Lords, it is fairly conventional that the government compartmentalises a number of bills. Some are labelled as financial services bills, some relate to taxation, some relate to competition, and some to other matters. But the effects are often interrelated. Changes in one place affect another, and therefore we should really be asking questions about the cumulative effects. This is one such bill and occasion. We are constantly told by the Chancellor that the government wishes to tax companies where their customers are, their sales and profits are made. Then the Financial Services Bill comes along and authorises Gibraltar-based companies to make sales to customers in the UK, generate profits in the UK, but book profits in Gibraltar, and thereby dodge UK corporation taxes. The government has actually, with this bill, destroyed the entire basis of its policy for taxing digital companies. The profits from the sale of financial services in the UK will definitely be shifted out of UK through concocted royalty and management fees, interest payments, transfer pricing games, and related party transactions. Of course, the profits will ultimately not be physically located in Gibraltar and will be spirited away by corporations and their controllers to unknown locations. The interaction between the UK financial services regime and the Gibraltar tax regime will definitely create unfair competition, as financial services companies located in Gibraltar will pay a lower effective rate of tax compared to their competitors in the UK. What the UK government is actually doing is providing an unfair state aid to Gibraltar companies. Indeed, on 19th December 2018, many of the tax advantages showered upon Gibraltar companies were classified as unfair state aid by the European Commission. The UK government has failed so far to adequately respond to that decision. And on 19th March 2021, the European Commission referred, and I quote, the United Kingdom to the Court of Justice of the European Union for failing to fully recover illegal state aid of up to around 100 million euros granted as a tax exemption for passive interest and royalties in Gibraltar. I do hope that the noble Lord Minister, that the noble Minister would tell us how the provisions of the present bill and their impact on tax avoidance affects state aid, and also what is the impact of the same on the trade and cooperation agreement between the EU and the UK, which requires, and I quote, both sides to be transparent about the subsidies they grant and to establish or maintain an independent body with an appropriate role in their respective subsidy systems. I very much hope that the noble minister would be able to tell us about the impact of this bill upon the UK's international obligations. Thank you, my lords, for your indulgence. Now, on behalf of the Right Reverend Prelate Bishop of St Albans, I beg to move Amendment 7.
Amendment proposed, page 28, line 23. At the end, insert the words as printed on the martial list. I call the next speaker, Baroness Bennett of Manor Castle.
My lords, it's a great pleasure to follow the noble Lord Seeker, who presented this amendment so clearly and effectively, while I also regret the absence of the Right Reverend Prelate, the Bishop of St Albans, who's been doing such sterling work in focusing on the real-world practical impacts of this bill on people's lives, their welfare, which, as we've discussed in other groups, the lack of effective regulation of the financial sector has done such damage to. At the committee stage in this debate on a similar amendment, the noble Lord Rooker referred to the brass plate economy and the damage that it does to a society if that becomes dominant. Indeed, much of our debate at committee focused on the well-being of the people of Gibraltar. Now, I've got no objection to that. Indeed, I welcome it. Of course, I wish them well in their difficult post-Brexit position, which they will put in despite 96% voting to remain in the EU in 2016. But we have to ask, with 20% of the UK insurance sector and a large amount of our out-of-control, seriously damaging sector going through Gibraltar's servers, with very little benefit to the people of Gibraltar, and doubt whether ending that would make any great difference to the people of Gibraltar. And as the noble Lord Seeker, who is, of course, one of your lordships' house experts in this area, has just outlined, very little of this money is actually likely to be seen in Gibraltar in any meaningful sense. Now, I note that the noble Lord the Minister in committee said, and I quote, "This proposal cannot be supported by the government because it does not reflect Gibraltar's economy." But I'm not sure that I understand this, as we're talking about regulating activities in the UK. That's very explicitly what this amendment's about, which surely is a matter of sovereignty, the issue to which the government is so attached. Perhaps the Minister can explain further in his answer. And also at committee, the noble Lord True said, quote, "The government was satisfied that the Gibraltar authorisation regime is rigorous," quote. Yet we have to ask why so much business is at least whizzing through in electronic form through Gibraltar without obvious reason. Now, the noble Lord Seeker pointed out at committee that Gibraltar has a population of around 33,000, but it has more than 60,000 registered companies, nearly 2 for every person living on the rock. Now, we know that Gibraltar as a society must need people to fulfil many roles, from childcare to garbage collection, food preparation, and probably now, much more than before, customs officials. The regulators of those 60,000 companies must be kept very busy, keeping a tight and careful eye on their activities. But perhaps, of course, it is simply the comparative corporation tax rates. As the Right Reverend Prelate Bishop was intending to say our corporation tax is 19%, whereas Gibraltar's is 10%. But of course, the government promises that our corporation tax rates will rise, become somewhat closer to international norms, if not just yet. So the disparity and the potential attraction is only like to increase. I referred in committee to the Tax Justice Network estimate that the Gibraltarian arrangements inflict costs of $4 billion on other nations, the largest majority of that likely to be in the UK. That figure could grow significantly with tax rises. So I would argue that the case for this amendment has become even stronger. And I remain, with many others, doubtful of the level of scrutiny, transparency. But ultimately, my lords, this is an amendment about activities in the UK, not about Gibraltar at all. It's about transparency, honesty, and ensuring that profits actually made in the UK are properly taxed in the UK. Thank you, my lords.
Speakers, I call first the noble lady Baroness Kramer.
Lords, I am very cautious about any further disruption for Gibraltar post-Brexit. I think the challenge that Gibraltarians face is going to be an exceedingly difficult one. And I do think that since the UK put Gibraltar into that situation, we really ought to be sympathetic and supportive. But I would also say I understand the motives of the Bishop of St Albans and others to increase transparency. But we are talking here about what at best is described as legal tax avoidance. We're not talking about tax evasion. And I hear nothing but widespread respect for the Gibraltarian tax authorities and the way in which they manage the business that falls under their supervision. I also think this is a dangerous time to be deciding to deny another party equivalence when we ourselves are seeking equivalence from the European Union. And I would point out, as others have done, that we have rather a low corporate tax rate at the moment. That's due to rise in the future, but we'll still be at the low end of the G7. But at the moment, we're exceedingly low compared to most of our EU competitors. So we also have granted equivalence to the EU, and that includes locations like Luxembourg and Ireland, which have much lower corporate taxes, much more akin to those of Gibraltar. So I really don't think we have a major problem here. I'm always glad to see an opportunity for transparency, but I think that in this particular case, we're not looking at shutting down criminal activities, which is the area where I would like to see us work very hard on transparency. And I think we need to be responsible towards the people of Gibraltar who sit in a position that is not of their choosing.
My Lords, the measures in this bill which refer to Gibraltar essentially create a single financial market. And really an essential component of such a single financial market should be a single registry standard. And so I really want to ask the government about their approach to this. When they decided to promote the measures in the bill in support of Gibraltar, did Her Majesty's Treasury conduct a review of the Gibraltar registry? And could the Minister tell us the result of that review? For example, could he tell us whether the Gibraltar registry is as transparent as that at Companies House? Now, noble lords will be well aware after Grand Committee that my opinion of the Companies House registry is pretty low, particularly in its inability, the Companies House inability, to provide a verified register of beneficial ownership, which is at the foundation of the noble prelates, the Right Reverend prelates' concern with tax issues. So could the noble lord assure us that the Gibraltar registry does have a verified register of beneficial ownership as well as being transparent?
I call the Minister, the noble Lord True, to reply to this short debate.
Well, my lords, I certainly regret, along with others, that the Right Reverend Prelate was unable to be here to to speak to his amendment, and we fully understand the reasons for that. Obviously, the House has great respect for his expertise in these financial matters, and we're also grateful to the noble Lord Sicker, for delivering aspects of his speech. My lords, given response to the noble Lord Sicker raised an issue relating to state aid, I should say for the record that the issue he referred to is a legacy state aid issue relating entirely to the period when the UK was a member of the European Union. And the government of Gibraltar has already recovered some of the aid and continues to work to recover the outstanding aid in compliance with the European Commission's decision to bring this case to a satisfactory conclusion as far as possible. Now, my lords, as we've discussed before, as fast as possible, as we discussed before, the financial services industry plays an important role in Gibraltar's economy. And Gibraltar-based firms have made extensive use of the existing market access arrangements between the UK and Gibraltar. And following the UK and Gibraltar leaving the EU, this bill will establish, as the noble Baroness Kramer alluded to, a new legal and institutional framework that provides for mutual market access and aligned standards in financial services between both jurisdictions. And this will enable Gibraltar-based firms to operate in the UK, provided that certain conditions are met, that law and practice are aligned, and that cooperation between the various authorities is in place. In this way, the regime respects Gibraltar's regulatory autonomy while ensuring the high standards of supervision and consumer protection UK customers expect. Turning to the Right Reverend Prelate's amendment, it would require any Gibraltar-based financial services firms, and this is a bill relating to financial services, my lords, carrying on an approved activity in the UK to register with Companies House and file accounts there. And the amendment also seeks to set up UK regulators as the supervisors for Gibraltar-based firms. Now, my lords, I'm afraid this proposal cannot be supported by the government because it does not respect Gibraltar's autonomy. Indeed, it goes against the very grain of the intention of the GAR. The first part of the amendment is intended to require Gibraltar-based firms to provide information related to profits and taxes. I must stress, as I have before, that as an overseas territory, Gibraltar is fiscally autonomous, and they have the right to set their own policy to support their economy within international standards and to determine their own tax rates. The scope of the GAR is focused on enabling continued market access for Gibraltarian firms to the UK market based on aligned law and practice. The GAR does not extend to taxation. The government of Gibraltar is committed to putting in place reciprocal arrangements for UK firms accessing the Gibraltar market, and I'm sure we would not contemplate this extending to the UK's tax regime. Gibraltar is already committed to meeting international standards on illicit finance, tax transparency and anti-money laundering, including those set by the OECD and the Financial Action Task Force. Gibraltar shares confidential information on company beneficial ownership and tax information. And Lord Eatwell referred to this beneficial ownership the registry issues with UK law enforcement bodies in real time, and have agreed to introduce publicly accessible registers of company beneficial ownership. On the second point in the amendment, it would not be appropriate to designate UK regulators as the supervisors of Gibraltar-based firms, and it is not necessary. The purpose of the GAR is to enable firms from Gibraltar to operate in the UK financial services market. It wouldn't be a cross-border regime if we asked such firms to register here and required that they were there supervised by our regulators. That wouldn't facilitate cross-border trade with our friends in Gibraltar. It would in effect be pushing their businesses to move here and impinge on Gibraltar's autonomy by extending UK authorities' powers into their jurisdiction. Again, something the UK would not contemplate in reverse. Of course, cross-border activity must be done in accordance with the standards expected in the UK market. That is why the GAR requires that before there is any market access, Parliament must first pass secondary legislation through the affirmative procedure in which the Treasury can designate activities as approved only where there is sufficient alignment of law and practice between our two jurisdictions and where there is sufficient cooperation between the UK and Gibraltarian authorities. Further, the bill will grant powers to the UK regulators that can be used if it is necessary to ensure effective supervision and address issues that arise, for example, in a situation that requires urgent action or where the UK regulators' view is that problems have not been adequately dealt with by the Gibraltarian authorities. The Government, my Lords, is confident that the GAR provides the safeguards needed to ensure financial stability and that our consumers will be protected by the high standards they expect, but in a way that respects Gibraltar's independence. I therefore ask that the Right Reverend Prelate should withdraw his amendment.
My Lords, I have received no requests to speak after the Minister, so I call on the Noble Lord Seeker to conclude the debate on the Right Reverend Prelate's amendment.
I'd like to thank all the contributors to this debate, which has been very informative and very, very helpful. I think when roughly 25% of the UK motor insurance is written from Gibraltar, it is clear that a large amount of profits made in the UK are being booked in Gibraltar, and the public purse here is being actually deprived of large amount of tax revenues. Now, of course, we might take the view that, well, Gibraltar has been hit hard by Brexit and therefore deserves some support. But as I made the point, those profits are not necessarily, the beneficiaries of those profits are not necessarily people in Gibraltar, but actually corporations who are using Gibraltar to extract revenues from the UK, because the ultimate destination of those profits is not really known, because there is really no transparency at all. Whether somebody is engaging in tax evasion or tax avoidance, the effect on the UK public purse is the same, which is actually the loss of revenues. I think I personally think that we still need greater transparency around it, but at the moment we don't have it. Hopefully, when we have a public form of country-by-country reporting, perhaps that will provide some form of transparency, but at the moment the government is not committed to a public form of a country-by-country reporting. But nevertheless, I thank everybody for their contribution to the debate, and with permission of the House, on behalf of the Bishop of St Albans, I would like to withdraw this amendment.
Is it your Lordship's pleasure that this amendment be withdrawn? Amendment by leave withdrawn. My Lords, we now move to the group beginning with Amendment 8. Anyone wishing to press this or anything else in this group to a division must make that clear in debate. Clause 34, Amendment 8, Minister.
My Lords, I beg to move Amendment 8, and will speak also to the other amendments in this group. My Lords, the Sewell Convention states that the UK Parliament will normally only legislate in areas that are devolved with the permission of the relevant legislature obtained through the legislative consent motion process. In recent weeks, despite the best efforts of ministers and officials from the HM Treasury and the Northern Ireland Executive, it's become clear that the legislative consent motions for relevant parts of this bill would not be completed before report stage in this House. It's therefore necessary to ensure that certain elements of this bill do not apply in Northern Ireland in line with the Sewell Convention. I'd like to assure the House that the great majority of the bill will have effect in Northern Ireland, as financial services is a reserved matter. However, it's necessary for Northern Ireland to be removed from the relevant parts of the statutory debt repayment plan and account freezing and forfeiture measures in Clause 34 and Schedule 12, with connected changes to Clauses 44 on extent and to 45 on commencement in addition. These are technical amendments which the Government has tabled to avoid legislating without consent. Our understanding is that the absence of a consent motion is due to current timing constraints rather than any concern about the substance of the measures. Legislative consent was not denied, the process was simply not completed. Amendments 50 and 51 will amend Schedule 12 so that certain provisions in that schedule will have different effects in Northern Ireland from those in England and Wales and Scotland. Amendments 38, 40, 41 and 42 amend clauses 44 and 45 to help give effect to the changes to Schedule 12. The amendments retain the status quo in Northern Ireland regarding the Proceeds of Crime Act, and the changes which Schedule 12 makes to that Act will have effect only in England, Wales and Scotland. It's important to be clear that these amendments will not affect Schedule 12 as it relates to the Anti-Terrorism, Crime and Security Act. Anti-terrorism is an accepted matter, and the changes which Schedule 12 makes to that Act will have effect across the UK. My Lords, Amendments 8, 9, 10, 13 and 39 have the effect of preventing most of the changes made in Clause 34 from extending to Northern Ireland. These are the provisions relating to the statutory debt repayment plan measure. Clause 34.4, which provides an express power to bind the Crown, will continue to apply to Northern Ireland. This is done so as not to disturb the position on Crown application that the Government considers originally applied in the Financial Guidance and Claims Act in relation to Northern Ireland. I'd like to reassure noble lords that Northern Ireland will still be able to make its own legislation, providing for a debt respite scheme of its own design, including similar provisions to those in Clause 34, if these are desired. UK government officials will, of course, continue to work closely with and support their opposite numbers with the design and implementation of a debt respite scheme for Northern Ireland if this is pursued. My Lords, I urge the House to accept these amendments, which are necessary to avoid legislating for Northern Ireland without the appropriate consent, and I beg to move.
Amendment proposed, page 40, line 14, leave out subsection 2. Lord Stevenson of Balmacara's name does not appear on the list, but he should have been included, and I call him next.
I'm grateful to the House for allowing me to speak at this point. I did actually put in a request, but it got omitted, and the Lord Speaker has expressed it well. The substance of the issues raised by the Noble Earl in his introduction, of course, are uncontestable. We do respect the devolution settlement, and we need to make sure that everything that we do is in accordance with that. I think he slightly misspoke in the sense that the Seoul Convention now does have statutory force rather than just being a convention. Indeed, it's often now called the Seoul Principle, I think. And certainly when we were dealing with matters arising in the Internal Market Bill, which came to your Lordship's House about 6 months ago, this was the way in which we addressed this particular issue. I understand the logic behind where the government is at the moment, and I understand the concern that they're expressing that they should not be taking steps which would in any sense vitiate the Seoul Principle as discussed. However, I was left a little confused, despite the clarity with which the Noble Earl and his usual clarity expressed himself. The debt respite scheme, as I understood it, was being progressed under regulations made under the Financial Guidance Act, and I think you referred to that. So it does seem a little odd to me that we are still concerned that that might not go ahead, or if it did go ahead, would be under regulations made within Northern Ireland rather than those which will apply in England and Wales. I think that from memory, this is going to be from May 2021, so we're not very far away from that. if he's able to do so when he comes to respond, I would grateful if he could just be a little clearer about that. If not, of course, he could write to me and perhaps we could discuss it outside the report stage discussions. The issue there is just a question of where that authority will vest going forward. Is it going to be as in relation to the UK Financial Guidance Act, or is it going to be a local legislation put through the Northern Ireland Assembly? Obviously matters may come out of that, how that's decided, but I'd just like to know. The other point really is the question about how we make progress in relation to the statutory debt repayment plans. The issue here, I think, is again a question of whether or not the necessary legislative consent order would have come through, and it hasn't, in relation to that. And I understand, again, if that is the case, perhaps the Noble Lord can confirm when he comes to wind up whether that is happening or not. If it isn't happening, isn't the situation a little different this time? Because as we're going to discuss in the next group, we're now being told that the time frame for the delivery of the SDRP is going to be something like the end of 2024, which is, after all, 3 and a bit years away. It does seem unlikely that there would still be a problem if we were waiting for Northern Ireland Assembly to consider that. We should be able to get through that in 3.5 years' time. So I wondered whether, again, if you could let us know a bit more about the detail about what the government's plans are in relation to that. And again, if that's not available within his notes at the moment, he can write to me about that and we can discuss it offline.
I call the next speaker, Baroness Kramer.
My Lords, the minute I saw this group of amendments, I knew they were above my pay grade. That I am in awe of the understanding of both Lord True and Lord Stevenson of Balmacara. That I did forward all of the amendments to those of my colleagues who deal specifically with the issues of Northern Ireland, and I think it travelled over to Northern Ireland as well for review there. And the message I got back was timing. I won't repeat the word that followed. That's timing problem, shall we say. That's not a problem.
I call the next speaker, Lord Tunnicliffe.
My Lords, I thank the Minister for introducing these amendments and for the explanation of them that was shared ahead of this debate. We will not oppose these amendments today, as it is right that changes should not be made without legislative consent. It is, though, very troubling that these provisions will go forward without Northern Ireland's inclusion, and that time has not been offered to allow the Northern Ireland Executive to pass a consent motion. It is my understanding that there were also difficulties on timing for a legislative consent motion during the Medicines and Medical Devices Bill. It cannot become a habit of this government to carve Northern Ireland out of legislation at the last minute or treat legislative consent as an afterthought. What conversations were had with the Northern Ireland Executive on the problem of timing, and were any measures to consider to allow them extra time as needed? Secondly, has the government identified ways to stop this from happening again? On the substantive issues, the result of this is that the bill will be passed without offering the same powers and protections to communities and law enforcement in Northern Ireland as it does in other areas of the UK. This is a particular concern for the statutory debt repayment plans, at a time when the impacts of COVID pandemic have placed extreme stress on people's personal finances. Then my final question is, what options are the government considering with the Northern Ireland Executive to ensure that Northern Ireland is given an opportunity to enact these provisions and communities in Northern Ireland are able to benefit from the planned support on debt and personal finance? Thank you.
Earl Howe to reply to the debate on his amendment.
My Lords, I'd like to thank Noble Lords for their various remarks, and may I just stress again that UK government officials will, of course, continue to work closely with and support their opposite numbers in Northern Ireland. And I hope the Noble Lord Tunnicliffe will accept that that is as far as I can go as regards our support for our Northern Ireland colleagues, because it is the ball is very much in their court as to how they wish to proceed and when. But as and when they do decide to proceed, they will, of course, get full cooperation from the UK government. I'd just like to touch on a question that Lord Tunnicliffe asked me relating to the Medicines and Medical Devices Bill, which also gave rise to an issue over legislative consent motion from Northern Ireland. The context for securing legislative consent for the Medicines and Medical Devices Act, as it now is, 2021, is quite distinct from that for this bill. In the case of the Medicines and Medical Devices Act, Northern Ireland executive ministers were asked to consider promoting a supplementary legislative consent motion on a second occasion as a result of amendments added to the bill during its House of Lords committee stage. And in that bill's case, the Northern Ireland Assembly had sufficient time to consider and pass a supplementary LCM before the bill's report stage in the second House, in this case the Lords. Report is considered to be the last substantive amending stage of the bill in the House of Lords, and consequently the last opportunity for the government to avoid legislating for Northern Ireland had consent been denied or not achieved in time. Unfortunately for this bill, it hasn't been possible to secure legislative consent in time, in spite of the efforts of our officials and those in the Northern Ireland executive. The noble Lord Tunnicliffe asked whether we can stop this situation happening again, and I would respectfully say to him that it really isn't in the control of the government here to order to influence the order of business and the work conducted by the Northern Ireland executive. It is largely in their domain, but it is. I hope my earlier reassurances will have been helpful on this topic. The background to this, to come to his earlier point and the noble Lord Stevenson's issues, is that the breathing space regulations, which are the second half of the SDRP measures, which come into force on the 4th of May this year, don't apply in Northern Ireland, largely due to there being no sitting assembly during the period of policy formulation and drafting of regulations. And as I've said, we've been advised by officials in Northern Ireland that it won't be possible to pass the LCM agreeing that Parliament should legislate on their behalf until mid to late April, which is too late for the Lords' report stage. So the amendment carves out Northern Ireland from Clause 34, as I've described, with the exception of Clause 34.4. And the government understands that the relevant departments in Northern Ireland do intend to take forward their own legislation for a debt respite scheme in due course. I'm afraid that Lord Stevenson has the better of me in his detailed questions, and I will need to write to him if he will forgive my not answering him now as regards where the precise authority vests in relation to a Northern Ireland debt respite scheme, and indeed how the government's plans for the debt respite scheme will pan out prior to the end of 2024. So with that, my Lords, I I beg to move.
My Lords, I have received no request to speak after the Minister, so I will now put the question. The question is that Amendment 8 be agreed to. As many as are of that opinion will say content. Contrary, not content. The contents have it. Amendments 9 and 10. Minister moves formally en bloc. The question is that Amendments 9 and 10 be agreed to. As many as are of that opinion will say content. Contrary, not content. The contents have it. My Lords, we now come to the group beginning with Amendment 11. Anyone wishing to press this or anything else in this group to a division must make that clear in debate. Clause 34, Amendment 11, Lord Stevenson of Balmacara.
Well, Lords, I declare an interest as a former chair of Step Change the Debt Charity. I'm moving Amendment 11, which is in my name, and indeed it is exactly the same wording as of the amendment to Clause 34 that I moved at committee stage. And the purpose is to give the government a further opportunity to set out in more detail the plans they have for the introduction of the statutory debt management plans in England and Wales, as we learn, not sadly in Northern Ireland yet, and to complement that which is already working as a very successful scheme in Scotland. We're getting there by patchwork, even if we're not able to do so top-down, as we might wish. My Lords, I'm very grateful to the Honourable Lord, the Minister and officials for facilitating discussions about the detailed SDMP proposals and for his very full letter of yesterday, which sets out the government's position very clearly indeed. It's a very good letter to have, and we got a lot of reassurance from that. So I also like to touch on Amendment 12 in the names of Baroness Bennett of Manor Castle and the Lord Bishop of St Albans, which introduces an interesting and important aspect of debt management plans, a bit of detail, in fact, and it's about the concept of negotiated debt settlements on behalf of debtors, something which actually is already part of the current debt management plan process in operation, certainly in Scotland and in England in an informal way, not statutorily backed. Because a realistic quantum for the outstanding debt is clearly a key metric when plans are being drawn up for what should constitute an affordable repayment schedule. And so it makes sense to both sides if the final figures reduce the outstanding debts in as short a time as possible. And I look forward to hearing further from the Noble Baroness and the Lord Bishop, who's able to join us, about how they see this working in practice. I think myself they're probably more suited for regulatory action than statutory action in this bill, but we will wait and see how the case comes out when it is argued. My Lords, yesterday's letter, as I've said, from the Noble Lord True, is extremely helpful, and I thank him for it. In the letter, he explains that the secondary legislations will spell out matters of detailed policy and implementation for the SDRP, and he confirms that as these will be introduced by the affirmative resolution procedure, these regulations will be given adequate opportunity for Parliament to debate and scrutinise, and I welcome that. At committee, my Lords, our main concern was timing, and the letter says that Her Majesty's Treasury intends to consult on the draft regulations as soon as possible after this bill receives royal assent. So we'll keep an eye out for them and hope it will not be too late after the royal assent comes through. On implementation, the letter makes it clear that, understandably, there needs to be time for IT changes and for preparing scheme guidance, and suggests that 18 months would give adequate time to stakeholders to prepare after regulations have been laid. I have no particular reason to question that timing, but given that the letter goes on to suggest that the SDRP may not actually be in use until the end of 2024, that does seem to me that we're talking about a delay of perhaps 3.5 years once work has started. And I do wonder if the government might want to look at that timetable again. We do need to get this right, clearly, and time must be given for that. But ministers are aware that the SDMP are really complementary to the debt relief scheme, which we were just talking about in relation to Northern Ireland, which of course is due to be operating on a much tighter timetable to be introduced, I think the Noble Earl, the Minister, said in early May. To be honest, I don't think I would be alone if I said that the Noble Lord, the Minister's hope as expressed in his letter, that this Times table reassures noble lords that the government's work will proceed at pace is not altogether convincing. Perhaps the noble Lord the Minister will respond at the end of the debate. My Lord, the letter also contains some very helpful reassurances in other policy matters. Debtors are protected from most creditor enforcement action during an SDRP, including enforcement by bailiffs. That's a great relief to hear. And we will come back to this in a later amendment, when it might be helpful if the government could clarify what creditor enforcement would not be protected under an SDRP. I think that would be useful to have on the record. The regulations... the letter confirms that the widest range of personal and business debts should be eligible for inclusion in an SDRP, and it's good to have that confirmation, and that this in particular includes local government debts as well as Crown debts. Again, it's just useful to have that clarification on the record. Only those with appropriately authorisations from the FCA will be able to offer SDRPs unless they are a local authority which offers money advice and therefore is exempt from FCA authorisation. Again, this clarification is helpful and welcome. And debt advice providers will not be able to charge a fee to debtors for accessing an SDRP. Again, this clarification is extremely welcome. Finally, my Lords, the letter covers the wider question of funding for the SDRP. I won't go into the detail here, but I just wanted to make it clear that we welcome the paragraph on the reassurance that funding will be provided separately for free debt advice, which will go a long way towards reassuring those institutions which have used the fair share funding formula to invest heavily in fintech and telephone services, which allow them to scale up the debt advice which is available free to at the point of use. And it, particularly during the pandemic, that's a very welcome piece of news, and indeed is the rock on which the plans for the debt respite scheme and the SDRP rest. My Lords, I and others in the debate this evening would, I know, be very happy to continue discussion of these issues with the Minister in due course, as indeed he suggested in his letter. But we wanted to get on record that we welcome what is said and the willingness of ministers to engage, and I look forward to having further discussions with them in due course. My Lords, I beg to move.
My Lords, amendment proposed, page 40, line 30. At end, insert the words as printed on the marshalled list. Our next speaker is Baroness Bennett. The speaker after Baroness Morgan has withdrawn, so the speaker after Baroness Bennett will be Lord Davies. Baroness Bennett.
My Lords, it's a pleasure to follow the noble Lord Stevenson of Balmacara and to offer my thanks to his support for the concept of Amendment 12, to which I speak to move. It appears in my name and is also kindly supported by the noble Lord Seeker and the Right Reverend Prelate, the Bishop of St Albans. The amendment seeks to secure a discounting of debt for people entering the proposed statutory debt repayment plans, something that, as the noble Lord Stevenson noted, has already occurred in Scotland. I set out at committee how this group of people is large, with incomes above those of those eligible for debt relief orders, but assets and income generally below those covered by voluntary agreements and bankruptcy. All of those other agreements operate in ways that can result in debt being cleared in a relatively short period of time, much shorter than those to be covered by the plans for the statutory debt repayment plans. I won't repeat all that detail again here today. But what this amendment represents is a development of an amendment presented at committee stage to secure a fair debt write-down in respect of debts sold on the secondary market. For that initial amendment and this amended one, I pay tribute to the large amount of work done by the Centre for Responsible Credit, from whom I believe noble lords will have received a briefing. While a strong argument exists to support this, there were entirely legitimate concerns raised in the debate that the impact of such a move on the operation on the secondary market would need to be properly considered. Lord True also raised a concern about the need for equitable treatment of debtors in the scheme. Taking these concerns on board, this new amendment, rather than being prescriptive, is permissive in nature and seeks to ensure that discounts on debt are secured where appropriate and with the full agreement of creditors. Amendment 12 recognises that many creditors listed on debt repayment plans, regardless of whether they originated the debt or bought it on the secondary market, would often prefer to receive a lump sum as full and final payment, as opposed to low levels of instalments spread out over many years. As a result, many creditors already offer a significant discount on the total level of debt if a lump sum settlement can be made. While the Step Change Debt Charity has a dedicated team to provide advice to debtors concerning possible full and final settlements, not all debt management plan providers do so, and there arises a potential conflict of interest as SDRP providers are likely to be reimbursed on a percentage basis of the total debt that is collected. Securing discounts for their debtors would reduce their revenues. This amendment therefore ensures that the government should be provided with a power to instruct SDRP providers, where appropriate, to enter into debt settlement negotiations on behalf of debtors entering the scheme. Hopefully this isn't needed, but it's important such a power exists. In addition, it ought to be possible for SDRP providers to go further. With appropriate funding and regulation, business models could be encouraged which would allow SDRP providers to themselves buy out and therefore discount debts registered on their plans. For example, in recent months, we've seen instances of debt of £10,000 being discounted by as much as 40% in return for full and final settlement. If such debts were able to be bought out and subsequently collected by SDRP providers, this would mean the debtor would only have to repay £6,900, even after taking into account a 15% fee for the provider. It should be possible to achieve a result that is beneficial to both creditor and debtor alike. I stress that building this negotiated settlement approach into the SDRP is likely to be welcomed by creditors who are already prepared to discount heavily, in many cases for lump sums in full and final settlement. Now, it's not my intention to push this amendment to a vote at this stage, but I do seek a commitment from the Noble Lord the Minister to continue to explore and work on this issue, and I hope that the Noble Lord the Minister can commit to a meeting between the Department and interested Noble Lords to see how we can take this forward, possibly in regulation. Thank you, my Lords.
I call the next speaker, Lord Davies of Brixton.
My Lords, I'm going to speak in support of Amendments 11 and 12. I don't intend to delay us particularly long at this time of night, but I just wanted to take the opportunity to pursue an issue. This has been my involvement in the Financial Service Bill has been a learning experience for me as a new member, and the way in which we're able to progress issues through the course of the bill, and the opportunity of rising at different stages and making points and developing what is possible to achieve as opposed to what we would like in a perfect world. I've made plain my support for a more fundamental debt jubilee, but that's clearly a discussion, a fight for another day. In terms of the amendments before us today, they clearly provide a useful step forward. A small step, but we are still one that's still worthwhile. I just really wanted to say a word on behalf of the debtors, those people who have taken on debts for all sorts of reasons, some of which good, some of which are bad. But I think you can't just look at the debtors in this situation and say that's where the problem arose. Quite clearly, bad debts are part of the business plan of people who make debt, people who lend money. It's part of their business. And I think what we've learned to an extent is during these debates is there are issues about how you develop a plan so that when debts are discounted, it's not just commercial organisations who benefit. There's also the opportunity for those who have unwisely or mistakenly taken on debts. They also gain some advantage from the discounting of debts. And I think that's really what we're trying to work towards here. And so I just wanted to say I support these amendments and hope that the government will be able to take on board the issues that are being raised. I think that the underlying issue that I just wanted to add was that I think there is a public interest. This is the point I've pursued before. There's a public interest in dealing with debt, of relieving people of the debts which they've taken on. It's not just something that helps the individuals concerned. It helps all of us to lower the level of debt. The removal of owners' debts helps all of us generally, and particularly at the moment when we are looking for an economic revival. So I hope the government will take on board the ideas behind these amendments and work towards a scheme that helps not just the debtors, but helps all of us as well. Thank you, my lords.
Following the next speaker, Lord Holmes, will be Baroness McIntosh. Lord Holmes of Richmond.
It's a pleasure to speak to this group of amendments. In doing so, I declare my interest as set out in the register. May I congratulate Lord Stevenson for the way he introduced this group and for all of the work that he's done in this area, not least step change. More than step change, he's done more than many marathons around this particular subject, and not just your lordship's house, but the nation is in his debt for the work he's done on debt. My lords, can I also thank my noble friend the Minister for his engagement throughout this bill. I know he's completely committed to this area, and I congratulate him for the engagement and the time that he spent with myself and other noble lords. Safe to say, this is an issue which will run longer than this bill. COVID, as with so many other issues, puts a new lens on debt and enables perhaps more people to understand that it's not necessarily for others, but potentially, just with a slight twist of circumstance, we are but a heartbeat, a breath away from being in tough financial straits. So I congratulate Lord Stevenson. I very much look forward to hearing the response of my noble friend, the Minister.
Thank you. I call the next speaker, Baroness McIntosh of Pickering.
My Lords, like my noble friend Lord Holmes, who I'm delighted to follow, I'm very grateful to Lord Stevenson and Baroness Bennett for giving us the opportunity in what I consider to be potentially probing amendments to explore in more detail how the statutory debt management plans will actually work. And just to say to my noble friend the Minister, when he comes to respond, that I'm really deeply uneasy that there is very little detail on the face of the bill as to how these provisions will work. And just to say, being a Scot by birth and a non-practicing member of the Faculty of Advocates, noble lords will recall that I started my legal career as a humble bar apprentice, working in a rather Dickensian attic along Heriot Row in Edinburgh, looking at debt collection as part of my role. And what I am impressed by, and I'm grateful to the Responsible Credit Association for their briefing. What does concern me is a sort of lack of urgency, may I say, on behalf of the government at this time. According to the Financial Conduct Authority itself, the pandemic has negatively impacted the finances of 20 million people, with problems concentrated, I understand, amongst the self-employed, who obviously have been particularly hard hit, and those who just went self-employed in the year before the lockdown restrictions came into effect. Also impacted those most heavily on incomes of less than £15,000 per year, and BAME communities. The FCA estimates that just under 1 in 5 adults is over indebted, with potentially 8.5 million needing debt advice. And on the previous National Audit Office methodology, apparently we can expect knock-on impacts of over-indebtedness, such as increased mental health problems and unemployment, to sadly cost the taxpayer in the region of £9 billion per year. So just a question to my noble friend, that rather than play for time and not see any detail, or not actually have a scheme in place before, I understand from the noble Lord Stevenson, in moving his Amendment 11 so effectively as he did, that the scheme will not be in place in England until 2024. So the question really must be, if there is a tried and tested scheme in Scotland which is working, could we not therefore adapt that scheme that exists in Scotland and have it operate in England perhaps in the next 2 years? I think that would really be a great help and would go to the heart of how we in the United Kingdom approach the issue of debt. I believe also that the Amendment 12 has much to commend it, and I look forward very much to hearing what my noble friend the Minister says in summing up this little debate. Thank you.
My Lords, I support Amendment 11 in the name of Lord Stevenson of Balmacara, and I remind the House of my interest as an ambassador and former president of the Money Advice Trust. Although Clause 34 may be seen as a relatively small part of this bill, we've had a great deal of discussion on it during the passage of the bill, a sign, I think, of how important SDRPs are. And throughout the process, I and other noble lords have been keen in particular to secure clarity over the timetable for introducing SDRPs. And I want to thank the Minister for his positive and constructive engagement on this issue, and for meeting me and the noble Baroness Lady Morgan to discuss the timings for the introduction of SDRPs. And like Lord Stevenson, I'm also grateful to the noble Lord the Minister for his letter yesterday, which did provide further clarity on this timetable. At committee stage, the government didn't accept my amendment to include a specific date by which SDRPs should be implemented. But I was pleased, nevertheless, to hear the Minister confirm that the complex and detailed process to prepare for implementation did actually seem to be entirely compatible with the end date I was proposing, albeit pretty tightly. So I hope the noble Lord the Minister will be able this evening to confirm that on the record by specifying the various stages of the Treasury's intended timetable for laying the regulations, and also reassuring the House that SDRPs are genuinely intended to have a commencement date before May 2024. And I look forward to the Minister's reply.
Kramer.
My Lords, let me join in the congratulations to Lord Stevenson of Balmacara with his amendment at committee stage, and then again his amendment here at report stage. He has clearly found a mechanism for engaging very fruitfully with the government, and therefore we all have the benefit of a letter that lays out some of the important and significant elements of statutory debt repayment plans. And for that I am grateful. I do join with Baroness McIntosh in being rather perturbed, and I think perhaps Lord Stevenson was as well, that the implementation date is 2024, and I think Lord Stevenson said towards the end of 2024. I really would advise that the government not to then use terms like at pace, which actually they use extensively in the Financial Services Bill, usually to argue that there's no time for a statutory instrument to be approved by Parliament, which takes a matter of weeks. But I am rather troubled, and it suggests that the government might want to think of some kind of stopgap to deal with the very significant number of people who will find themselves with debt problems as we come to the end of furlough and people find that, in fact, they've been moved into permanent redundancy, that other jobs are hard to obtain. I'm thinking in terms particularly of a lot of young people who are becoming out of university courses and won't find the usual opportunities. I mean, we're going to go through a very rough period for quite a number of people who will find themselves loaded down with private debt, not because they have behaved inappropriately in any way at all, but because of the way events have hit them. And it seems to me that they will need some sort of additional support and rescue rather than just the schemes that are in place. And of course, that the SDRPs would almost certainly have been ideal for many of them. So I hope the government will look at events that are going to force a lot of people into a very difficult position. Amendment 12, that's moved by Baroness Bennett, that does what I think Amendment 55 at committee was intended to do. And this time I think it does it. It's designed to enhance opportunities for people who have signed up to SDRPs to be able to pay off their debts early at a discount. Now, it's going to need some structure, and I suspect some engagement from social enterprise groups, perhaps even by the government, providing some measure of support, because I think there's going to be a need, at least for seed funding, to get a scheme like this off the ground, and I hope the government will think some of that through. But it does seem the kind of scheme that would enable people to get back into the financial mainstream more quickly. And that surely is something that we want to achieve. And again, the need for that will be more acute because of the extraordinary number of people who will find themselves knocked into a debt situation as a consequence of COVID. I don't actually think it needs legislation, so I'm glad that Baroness Bennett has chosen not to move it today. But I would say that these two amendments do highlight the need for some serious thinking on how the government can best support people who will be coming out of COVID and find themselves in fairly difficult circumstances. Usually when we work with people who have debt problems, there is a fundamental issue that has to be dealt with that has led them into that corner. That sometimes it's to do with lifestyle choices, but very often it might be mental health issues, it may be family breakdown, problems of that kind. But the group that will find themselves in problems with because of the COVID impact don't fall into that category. Therefore, with the proper helping hand at the right time, they can very quickly and easily be moved back to a place where they are no longer financially excluded or find themselves in financial difficulties. And that has to be absolutely necessary if we're to see the recovery that we're all hoping for. So I hope the government will look at these two amendments and continue to build off them rather than to consider that they are concluded because report stage has passed.
I call the next speaker, Lord Tunnicliffe.
My Lords, we welcome the retabling of Amendment 11 by Lord Stevenson, which provides the Minister with an opportunity to provide more detail on the Government's intention in relation to the introduction of the statutory debt management scheme. We're grateful to the Minister and officials for the various meetings that have taken place in recent weeks and hope that even once this bill has passed, there will be opportunities for further cross-party dialogue on issues relating to personal debt, financial resilience, and so on. This was a lively debate at Grand Committee with various different amendments tabled from colleagues across the House. Despite the number of amendments, almost all noble lords were united in expressing that the government must get on with introducing the scheme. Amendment 12 by the noble Baroness Bennett and co-signed by the Lord Bishop of St Albans deals with some slightly broader issues relating to problems debt, and we hope the Minister can provide a full response to those points. either now or in writing. I am struck by this group of amendments and the next on BNPL and financial exclusion, just how important it is to adopt a more holistic approach to personal finance, such as those proposed in Lord Stevenson's previous amendment on the concept of financial well-being. My Lords, helping people with debt really has to be important. I simply have trouble understanding how people cope with the situation. And I think it is the role of the state to provide structures to allow people in a managed way to take on their debt problems. And I look forward to the Minister's response to Lord Stevenson's amendment.
Lord True.
Well, my Lords, I'm grateful for the opportunity to be able to respond to this debate. And in opening, I really would, in the most genuine sense, like to thank all those noble Lords who've spoken in committee and today, and indeed those that I had the privilege of meeting and discussing these matters with on engagement. I think that all those discussions were useful, and the government has certainly listened to them, and I hope both in my letter, which I placed in the library of the House, and today I'll be able to assure the House that that is the position. My Lords, I think one of the things I found most pleasing was, I think, the sense of unanimity, which is rare in this House, that we were on the right track so far as seeking a scheme of this kind is concerned. I mean, the SDRP is a new solution for people in problem debt, and it will provide a revised long-term agreement between the debtor and creditors. And debtors will be protected from most credit enforcement action and from certain interests and charges on debts in the plan. And following committee stage and the value discussions I've referred to, I did write to Lord Stevenson, Lord Lucas and Baroness Cousins with some further detail. And the noble Lord Stevenson of Balmacar indeed referred to aspects of that letter. But your Lordship's library is not open to everyone, my Lords, particularly at this time. And given its importance to today's debate, I hope your Lordships will indulge me if I do take some time to place on public record some of the key commitments set out in that letter, because they are commitments made on behalf of the government. My Lords, I would like to ensure also that all noble Lords do understand the timings that the government is working to. I did say something in committee in response to the noble Baroness Kramer, about the range of support that the government is giving and to people at this difficult time, and she's quite right to refer to the difficulties that there are and will be. And obviously, in the meantime, as we're working on SDRP, the government is pushing ahead with the implementation of breathing space scheme to come into force on the 4th of May this year. And other voluntary and statutory debt solutions will continue to be available to debtors to consider in the meantime. Now, my Lords, returning to the process which has interested a lot of noble Lords, the Treasury is currently working on drafting regulations for the SDRP, and it intends to consult on these as soon as possible after this Financial Services Bill receives royal assent. As well as preparing the regulations, the Treasury will also need to work with the Insolvency Service and others to implement new IT systems and develop scheme guidance to aid stakeholders in implementing the policy. It's also important, obviously, to give stakeholders adequate time to prepare so that the regime can be properly implemented. So given this, I can confirm on the record that the government expects that the SDRP will be implemented in 2024. And in order to achieve this, the government will aim to lay the necessary regulations by the end of 2022. Now, I'm sorry the noble Lord Stevenson of Balmacar was disappointed by the specifics of my letter as to timing. Indeed, that's been alluded to by others. But I repeat, it is the government's clear aim and intent, as the noble Baroness Cousins was kind enough to say, to operate on that timetable with the most appropriate dispatch. And asked why the SDRP regulations might not be able to be laid until the end of 2022, the reality is the Treasury is currently working on drafting those regulations. And I have explained it is a complex undertaking and will require input from stakeholders inside and outside the government to finalise before a consultation on regulations can be published. And that consultation, in turn, will need to give a reasonable amount of time, we're often criticised for insufficient consultation, for stakeholders and members of the public to reflect and respond. We must allow sufficient time then to properly consider those responses. Their views will need to, as appropriate, to be reflected in the draft regulations before they're laid. The timetable will also need to accommodate the necessary clearances in government and Parliament for publications and legislation. But I do, my lords, know that noble lords on all sides, including this side, will wish for the SDRP to be progressed in a timely manner, and the government has certainly understood your lordship's strength of feeling on this matter. Now, I know that the noble Lord, Lord Stevens of Balmacara, also wished to understand some of the details of the regime further. And as he's made clear, that is what his Amendment 11 seeks to explore as a probing amendment. And so I repeat on the public record that the details of the SDRP regime will be set out in affirmative secondary legislation, and so Parliament will be able to consider the exact details close to the time. I can also reassure noble lords that Section 7 of the Financial Guidance and Claims Act 2018, as amended by Clause 34 of this bill, will contain powers to allow the government to include such features in the SDRP as suggested in this amendment. However, in response to the noble Lord, Lord Stevenson, I will set out further detail on how the government expects the regime to function. First, on the question of who can offer an SDRP, it is envisaged that only debt advice providers with appropriate authorisation from the FCA will be able to do so. That is, unless, as the noble Lord, Lord Stevenson said, they are a local authority which offers money advice and are exempt from FCA authorisation. Debt advice providers will not be able to charge a fee to debtors for accessing an SDRP, and this is the same approach the government's taken in the breathing space scheme. Second, on the question of funding, we expect that the administration costs of the SDRP will be funded by deducting 10% from debtors' monthly repayments, of which 8% will be provided to the debt advice provider, 1% to the insolvency service, and a further 1% to the payment distributor. This proposed 10% fee is expected to be sufficient to cover the costs of administering the SDRP by the parties involved, while also providing fairness to creditors. But of course, my lords, the government will keep this under review. Third, on question of debts to the Crown, our consultation response sets out that the widest range of personal and business debts should be eligible, including financial services debt, household bills, and local government, and debts owed to central government. I was asked by the noble Baroness Cousins about enforcement action. Details of what kinds of enforcement action will be prohibited in an SDRP will be set out in regulations, which will be consulted on. In the breathing space scheme, types of enforcement action are set out in regulations. The list's not exhaustive, my lords, but specifically sets out the actions which are prohibited during a breathing space. These include, for example, obtaining a warrant, starting legal proceedings, and selling or taking control of a debtor's goods. And finally, on protecting people from the actions of bailiffs, we will have an opportunity to discuss this later in report, my lords, but debtors are expected to be protected from most creditor enforcement action during an SDRP, including action by enforcement agents such as bailiffs. I hope setting these points on the record will satisfy the House and the noble Lord Stevenson of Balmacara, and that he will be able to withdraw his amendment. Turning to Amendment 12, which would provide that regulations establishing the SDRP may include a provision that would mean debts could be repaid in a single transaction and possibly reduced by agreement with creditors. Again, I'd like to take this opportunity to remind noble lords that as a repayment plan, the SDRP is intended to support the repayment of debts in full over a period of time that is reasonable and appropriately reflects the debtor's circumstances and ability to pay. It is intended to help individuals who do not have the financial means to pay off their debts in a single transaction. The SDRP necessarily balances the interests of debtors and creditors and aims to maximise returns to creditors while supporting people struggling with problem debt. Were the debt value to be reduced, as suggested by this amendment, this could have a disproportionate effect on creditors. Other statutory debt solutions, such as debt relief orders, offer debt relief to people for whom repayment's not a realistic prospect. The average plan is expected to last around 7 years. How much a debtor can afford to repay every month will be determined by the debt advisor. The government's 2019 consultation proposed they would use a standard financial statement, which is an industry-wide method of calculating income and expenditure, to do so. This amendment could also allow the regulations to create a situation where the debt advisor would take on liability for the debtor's debts by making a one-off payment to the creditor on their behalf and then clawing this back from the debtor during the course of the SDRP. Such an arrangement would change the policy intent of the SDRP and impose significant financial liabilities on debt advice providers, many of whom, my lords, are not-for-profit or indeed charitable organisations. So I understand the purpose behind the noble Baroness Bennett's amendment, but we believe that the approach that I have set out today on the SDRP is the right approach. And I must tell the noble Baroness that we will not be able to accept her amendment either now or at third reading. But, my lords, Her Majesty's Government, of course, will be open to conversations with all interested parties as work on the scheme goes forward. And I hope that our openness in the course of this bill is an earnest of that. So it's for these reasons that I ask that these amendments be withdrawn.
I've received no requests to speak after the Minister. Lord Stevenson of Balmacara.
My Lords, I'd like to thank all those who participated in this short debate. It was unfortunate that we've, because of timing and other pressures, we've lost the contributions from Baroness Morgan of Coates and indeed from the Lord Bishop of St Albans, both of whom I think had interesting points they wanted to make in the debate. But despite that, we've touched just about every issue that needed to be looked at, and indeed have gone a bit further. And I'm very, very pleased that the debate has taken place, even though we are just past our closing time. So I'm just going to take a few minutes just to wind up by touching on a couple of points. Of course, I'm deeply embarrassed by the idea that in some way this initiative is all my responsibility and I should get all the credit for it. That is certainly not the case. This has been a team effort by many, many groups and bodies, many of which were actually referred to by the Noble Lord Minister in his remarks. And we should pay credit to the not-for-profit and charitable bodies who have been working tirelessly over many, many years to get unmanageable debt sorted out in our society for all the reasons that Lord Davis of Brixton said, because it is a cost to the public good. I think we did a calculation when I was at Step Change Debt Charity, which suggested it was probably costing about £9 billion a year. And I was interested that Baroness McIntosh also came up with a figure very close to that. It is important that we have a mature and sensible debate about debt, about how it happens, how it arises, how it gets resolved. And the great thing about today that I take away from it is that we are able to do that in Your Lordship's House in a way which is reflects the very best of our ability to contribute to these debates, and also with a listening government who is prepared to take it back and to see if there's a way in which legislation and regulation can be adjusted for that. So if we can understand a little bit more about why debt happens and what people want to do about it, I think we will all benefit from that. My experience at Step Change was rather unexpected when I first went there, because I thought it would be largely a collection of feckless people who'd got themselves into overspending and debt. But in fact, the truth was our median client was probably in their 50s, had lived a blameless life, had done everything they'd tried to do in order to make sure that their outgoings and income matched, that there wasn't a debt problem for them, and that they did the best for themselves and their families. And it was always, as somebody I think said in the debate, always an unexpected issue. Somebody got ill, somebody lost their job unexpectedly, there was some other crisis that occurred that tipped them over into a situation for which, and this was a message that came off time and time again, they really did not have the tools within their own personal skill set to be able to deal with it. They didn't understand the financial system very well. They couldn't understand where they could get help from. There was a very confusing amount of people out there trying to make money out of the problems they were in, and they struggled. And it's only because of Step Change, Money Advice Trust and others, Citizens Advice, who've worked, and Christians Against Poverty, who have done fantastic work over the years, that we've got ourselves to the point where we can see a way forward on this. And this legislation will help tremendously. There's no doubt about that at all. And I'm very grateful to government for having listened and having thought through the issues and have come forward with sensible plans, even though, like others, I regret the timescale that we're on. But nevertheless, I'm sure we can get it right. The Noble Lord the Minister, I think, echoed a lot of the goodwill and support around the House that I've been reaching out to. But if he thinks this is the end of the line, he has another thing going. I have a long list of things I'd still like to get done, things that have got away so far, but I'm going to try and make sure I do before I stop. If we get people off unmanageable debt and back into society, they often come with terrible problems about getting a credit rating. We must be able to attack that. Even getting a credit card after you've been through a debt process is very difficult to do. There are a whole series of issues that could come in under the process that we talked about in an earlier amendment about financial well-being, which I think we could look with advantage to try and build on where we are today. And I think that if we can, as Baroness McIntosh said, have a sensible discussion about who is affected, why it happens, how we can do the best by them, then I think we will all benefit from that. And with that, I'd just again like to thank people for the contribution and beg leave to withdraw this amendment.
Is it your Lordship's pleasure that this amendment be withdrawn? Amendment is by leave withdrawn. Amendment 12, not moved. Okay. Amendment 13. Amendment 13, the Minister has moved formally. I shall now put the question. The question is that Amendment 13 be agreed to. As many as are of that opinion will say content. The contrary not content. The contents have it.
My Lords, I beg to move that further consideration on report be now adjourned.
The question is that further consideration of report now be adjourned. As many as are of that opinion will say content. The contrary not content. The contents have it.
My Lord.